if I talk of Surat, I'm sure the tax audit would be one of the very big areas of the practice, and it becomes very important for the purpose of chartered accountant fraternity as such to keep on looking into amendments, revising our basics, keeps on checking on the Income Tax Act also, because ultimately tax audit deals with the provisions of the Income Tax Act, and whenever there is an amendment in the Act, it does have an effect to our tax audit also. There may be an addition in the clauses, there may be deletion in the clauses that do make directly impact on us. But then there is other areas also, wherein in the existing clauses also new judgments keeps on coming, which I believe that we should always consider it when we are actually undertaking the tax audit. So what is objective of tax audit? Broadly, as everybody knows, tax audit has been prescribed under the Income Tax Act under Section 44AB. The basic objectives are for examination or review of accounts of any business or profession carried out by taxpayer. So the accounts have to be examined, it has to be reviewed, and opinion has to be given by the auditor. That is the main objective of the tax audit. There can be two types of audits, wherein the accounts are already been audited by under any other law. And there would be a case where the accounts, let's take a property concern or a partnership firm, which are not been audited under any other law. So in which case, even the balance sheet audit also becomes form part of the tax audit, because ultimately the audited balance sheet will be annexed to the tax audit. So it is not only filling up the form 3CD, but it amounts to review of complete accounts when I am talking of tax audit, because I am also trying to cover not only from a perspective where the statutory auditor is different. To ensure correctness of implementation and proper compliance of tax provisions envisaged under the Act. So this was one of the main objectives why the tax audit was introduced. The government felt that it is difficult for the assessment officer to verify and ensure that all tax provisions are implemented properly. And therefore, the tax audit was introduced almost 32 years back now. So to ensure that all the correct tax provisions wherever applicable are being properly implemented. And if there is any improper implementation is not done, due to which there would be an impact on computation of it, they are covered under the tax audit, or they are been highlighted in the tax audit by the tax auditor. That was one of the major objectives. Third, it enables a tax authority for verification and assessment. Technically, the objective of tax audit when it came, as I know, it was that once the tax audit is done, really speaking, whether the assessment is at all required, because most of the sections would either be covered in this particular clauses, allowances, disallowances, whether it's a capital, whether it's a revenue, whether it's a personal expenses, tax audit provides for it. So the objective of tax audit was that when the tax auditor is reporting any particular figures for allowance, disallowance in his tax audit report, then whether really the verification and assessment is required. If the objective of tax audit was that if the tax audit figures are adopted, then the correct computation of income can be drawn, and it may actually do not require any further verification and assessment. But if you see over our experience of last 30 years, even after tax audit is happening, the assessing officer has been accepting tax audit or may not be accepting it, but he entails into a detailed verification and assessment proceedings are being done. Therefore, to that extent, I believe the objective of tax audit was never actually achieved, because the objective of tax audit was that assessment should not have happened in the multiplicity of the cases. Of course, day by day, they have reduced the scrutiny of the cases. They are now more relying upon the tax audit figures. Even if you see when 143(1) have been issued today, they do rely upon the tax audit figure. There is also comparison made between the amounts reported in the tax audit, amounts reported in ITR. That comparison has been done. And 143(1) those are reported. And that was always an objective, that what is reported in tax audit is properly captured in the computation. And therefore, the verification and assessment per se might not be required. The verification will be done on a prima facie basis, and the assessment could have been done in a summary basis. That was the objective. What is our responsibility? Of course, our responsibility is widening day by day. It is increasing. There are a lot of penal provisions are also coming now on the auditors, even in the Income Tax Act, if you are not doing properly. But I would just summarize in a very small point, just to remind what is our responsibility when I am doing a tax audit. We have to express an opinion on financial statements based on audit conducted in accordance with standards issued by ICI. So we have to express an opinion on financial statements. Obviously, because I would be, if I'm not doing statutory audit, there is no statutory audit required. I am the only person who is certifying the financial statements. So when I'm certifying the financial statements, our responsibility is to ensure that financial statements are drawn in accordance with the standards issued by ICI. If I am also a statutory auditor and the assessor is required to be audited under a particular statute, then obviously I have to ensure that those are prepared based on the standards issued under the company law or under the respective law. And if there is no specific standards prescribed under that particular entity where it is registered or where it is licensed, then obviously the standards issued by ICI. Obtaining sufficient and appropriate audit evidence. Now, of course, this is a broadly our responsibility. Audit evidence is quite a detailed thing. If there's a full set of it, we may go into it. What is an audit evidence for each type of transactions, each type of clauses? There are different type of audit evidence which are prescribed in detail for our guidance. To verify the statement of particulars required to be filled under Section 44AB. So Section 44AB, as we all know, describes the form number 3CB, which has a significant impact in affairs of the taxpayer. So it covers all those clauses. So it's our responsibility to verify the particulars which are mentioned over there are correct and accurate, and they show the true and fair view and of the accounts thereon also, and based on which a computation of income can be properly drawn. That's the most important thing. Applicability of tax audit. Section 44AB is the section under which the tax audit has become mandatory under the Income Tax Act. So I think so somebody is raising hands. Anurag, is it something is it audible or something?
I think they have raised hand by mistake.
Okay, it's a mistake, so I should continue.
We'll take the question answer at the end.
Okay, okay, fine. So applicability of audit is prescribed under Section 44AB, which is the section which, according to which every assessee has to get an account audited under Income Tax Act, which prescribes a basic threshold. And as you all know, the threshold of audit under Section 44AB is now become a threefold. Initially, the limit was only 1 crore, and now it has been increased to 5 crores in case of certain conditions are fulfilled. So we'll go into particular conditions. So as you know, as of today, if your audit, if turnover is less than 1 crore, then you are not required to get an accounts audited under Section 44AB. I'm talking of Section 44AB. So if your accounts under Section 44AB, if your turnover, sales turnover of gross receipts is less than 1 crore rupees, then there is no requirement of getting an accounts audited under Section 44AB. Similarly, now this limit has been increased from 1 crore to 5 crores from the financial year 1920, that is assessment year 2021, which say that in case of certain assessees, that the limit instead of 1 crore would be rated as 5 crore rupees. In case if you are fulfilling certain conditions. Now there are two conditions which are prescribed. We will go into detail, but broadly the two conditions is that the total cash receipts and cash payments should not exceed 5% of total receipts or payments. I would state that, including your amounts received for sales, turnover, or gross receipts. So if you are fulfilling this criteria, then the limit applicable for the purpose of the audit would be 5 crore rupees. Then if your turnover is less than 1 crore and whether 44AD is applicable to you, you are falling under you are an eligible assessee under 44AD. This is applicable only if assessee. So what was that, if you remember before 2017, if your turnover was below 1 crore and you were falling, you were eligible assessee under 44AD, and if you were not offering the tax at the 8%, then the audit was made compulsory under 44AD basically. But now what it is, even if your turnover is less than 1 crore, or it is between 1 crore and 2 crores, and you are an eligible assessee under Section 4480, if you offer for a particular income tax which is less than 8%, still the audit would not be applicable because there is an exemption up to 1 crore. Anyways, there is no audit under 4480. and up to between 1 crores and 2 crores, there is an exemption provided under section 44 AD itself. So only in a certain criteria, then the audit would be applicable. I'll just go to the other sheet which will clarify the various scenarios. So I tried to summarize it to one particular chart, wherein how we can look into it, whether the audit is applicable to a particular business or not. Let's take an example. If my turnover is less than 1 crore, so there are two areas whether 44 AB is applicable or not. As we have discussed, if my turnover is less than 1 crore, 44 AB is not applicable, no tax audit required. Let's take a case that my turnover was less than 1 crore and still because my profits were more than 8% or 6%, so I took a benefit of section 44 AB. During financial year 18-19, I took a benefit of 44 AB because I didn't want to file my returns based on my income which was generated in books of accounts. I opted for a presumptive scheme. Since my turnover was 1 crore, it was, say, example, I offered for tax 8% or 6% depending upon cash or check posted. I offered for tax. Now coming to financial year 1920, when it comes to a 1 crore, because 1920 has not been good and my profits are below 8% or 6%, I don't want to opt for 4480. So once I do not opt for 4480, then that 4480 presumptive scheme is not available to me for the subsequent 5 years. And if out of that income, if it exceeds my maximum amount chargeable to tax, which is 2.5 in case of individual proprietor, in firm even a 1 rupee is taxable. So if maximum amount which is chargeable to tax, if it exceeds, then 44AB gets applicable. So once you are opting out of, or once you have opted for 4480 in the previous years, and you want to opt out of 4480, please mind it, then you cannot go back to 4480 for the next 5 years. And at the same time, if your income is more than the maximum amount chargeable to tax, then 4480 is applied, irrespective your turnover will be less than 1 crores. Coming to another part is more than 1 crores. So if your turnover is 1 crores to 2 crores, you have an option to opt for 44AB or 4480. Now, if I opt for 4480, I offer for tax 8% or 6% depending upon my turnovers, whether it's a bank turnover or it's a cash turnover. Then I get an exemption under 4480 and I do not have to carry out the audit. But if I do not want to opt for it, then I may have to, if I opted, and if I decide that in the subsequent years, I don't want to opt for 4480, then again I will go to a chart which I have shown it on the bigger screen, which says less than 1 crore, once opted, and then I'm opting out of 4480, then audit again becomes compulsory. So between 1 crores and 2 crores also, I can come out of audit if I'm offering for tax under 4480 presumptive basis. But after offering, if I'm coming out, audit will be compulsory. Now, let us take a situation where it is a new entity. It's a first year entity for financial year 1920. I have become a new entity. There was I never opted for 4480 benefit previously. I'm filing my return for the first time. Then what happens? If my turnover is between 1 crores, 2 crores, and I'm opting 4480 for the first time, I'm not doing an audit. In case of below the 1 crore, also I'm not doing audit, even if I'm offering less than 8% in those cases in the first year, because I've never opted and now I'm opting it out. Coming to a third portion, where more than 1 crores, so 44AB states that if my turnover from the cash, if my cash receipts or cash payments is not exceeding 5% of the total receipts or payments, then for the purposes of 44AB, 1 crore would be rated as 5 crores. So I need not carry out any audit under section 44AB if my sales, turnover or gross receipts, as the case may be, is less than 5 crores. And out of that 5 crores income, 5% my cash receipts is less than the 5% of the total turnover. Similarly, on an expenditure side, on the payment side, if my cash payments are less than 5%, then I will not fall under the audit. Coming to above 5 crores, 44AB is clearly applicable. There's no question, no discussion. 44, I will discuss in the subsequent slides how this 5% issue would be settled, because there is a lot of controversy. That's a main issue which has been happening across the fraternity. We'll try to address that in the coming slides once I cover up this. For the professionals, we have a provisions of 44AB and 44ADA for the professionals. So if your turnover is less than 50 lakhs, and if you opt for the presumptive tax, wherein you offer 50% of your turnover as the total income, then 44AB will, less than 50%, then the 44AB will apply and audit has to be applied. In case of more than 50 lakhs, 44AB will apply. So there is no change as far as professionals are concerned, unlike when this time finance minister said that I want to reduce for small medium enterprises. Obviously, with to our surprise, there was no consideration for professionals. Like for business entities from 1 crore to 5 crores, they have given an increased limit for a particular conditions or fulfillment. But for professionals, there is no change. It remains as it is. If after turnover is more than 50 lakhs, 44AB will apply, and 44AB will apply in case of less than 50 lakhs only if you are not offering more than 50%. Interpretation of 5% of total receipts or payment. Now, this is the most burning issue in today's time, and a lot of discussion is happening on the institute level also to issue the clarification on this, that how it should be calculated, what should be calculated. There are, I keep on getting curious that whether there could be various situations, because the wordings are aggregate of total receipts, including sales, turnover, or gross receipts. So the question arose when the definition says that it is aggregate of total receipts, whether what should be the receipt mean. So there are two things to be calculated for purpose of determining applicability of audit. One is, I would say, numerator, and one is denominator. Numerator is 5% of cash receipts, and denominator would be total receipts. So how do you determine cash receipts and total receipts? There are 2 or 3 questions which have arisen in the industry. What I believe, that when you say that total receipts, would you mean that total receipts includes all sort of receipts which are not in nature of income? I'm talking on income side before going to expenditure side. Would it be all side of receipts which is on the income side, or it would include other side of receipts which are not included? Let's take an example. I have the debtors which is appearing opening debtors, and I've received certain amount in the current year, so it becomes a receipt of the current year. So while applying this formula, whether for the purpose of total receipts, whether I should consider the receipt of opening debtors or not, this is what the question has arisen. Similarly, there were certain questions came in mind that whether the loan receipts should also be accounted for or not. Similarly, if I'm repaying the loan, should be accounted on the payment side or not. So there are various. So some fraternity also discussed to an extent that I should take a bank statement, and whatever are my receipts and payments, I should do a summation. At the same time, I should do a cash book summation and add up all receipts and payments, and then do a comparison on a numerator and denominator. So there has been a various discussion on happening. The way I look at it, in my view, 5% of total receipts or payments, when we talk of, it talks of aggregate of total receipts, including sales, turnover, or gross receipts. When I talk of aggregate of total receipts, and in the later part it says inclusive. So once it says include, that means it becomes an inclusive definition. That does means that the earlier portion of aggregate total receipts is much wider than the including definition. And therefore, why should not this, when we talk of total receipts, all payments, all amounts received, irrespective of whether it's in nature of income, whether it's towards sales, or whether it's towards any balance sheet item, why it should not be considered that into discussion? Because the language of the particular section is used in such a way. But to my mind, and in my view, when we are talking of 44AB, and when we talk of provisions from section 28 to section 44, we are confining our interpretation to business income. We are concerned with the businesses. Obviously, it can be argued that the receipt of the debtors is also a business receipt. Receipt of a loan is also for the purpose of business, and therefore we are also reporting it a tax audit when the loan chart we are reporting for the purposes of loan. It can be argued, but when it comes to a purpose of other sections of 44B, we need to go into the history wherever it has been used, word receipts or words payments or word expenditure has been incurred. If you see the provisions of 40A3, if you see provisions of 40 subclause A, subclause 1A, which deals with disallowance of TDS, at all times there is a lot of precedents have occurred. Okay, this particular provisions will apply only to the items where you are claiming an expenditure. So if you have an incurred and particular expenditure, or if you have accrued any particular income in the particular profit and loss, then only this provisions will apply. In fact, to a certain, there were judgments when it came to 40A1A and 40A3 also, that if it is a capital expenditure, also would not be covered when we are interpreting these sections for the purpose of determination of computation of total income. It is well known. The purpose of the tax audit is also for determination of correct computation of total income. So when you are doing the tax audit, further, my mind also goes at this time before interpreting this, that when an explanatory memorandum to the budget came in, at that time the words which were used, it never said an inclusive definition. There was never in an explanatory memorandum, the inclusive definition has never been used. I will just read it. What did the explanatory memorandum said at that moment of time? The condition number 1 said, aggregate of all receipts in cash during the previous year does not exceed 5% of such receipt. That's all. It does not talk of inclusive definition, which creates more confusion. 2, aggregates of all payments in cash during the previous year does not exceed 5% of such income. So when the actually, if you see the explanatory memorandum, it does not actually states that including sales turnover. According to me, the confusion is arising because it is an including definition. And once it is an including definition, the words prior to including becomes much larger. That has been always been interpreted. But when I am interpreting 44AB, there is also principle of adjustum generis. Though after putting a word including, it amounts that it cannot be limited. But when you see the objective of it, according to me, we should limit it only to the purpose of the income and expenditure. I cannot include all other receipts for the purpose of this. I will give an example. Let's take an example. I have out of the 5 crores of turnover, I have a cash receipts of 1 crore rupees. So technically, I have more than 20% of the cash receipts of the turnover, 5 crores. If I expand this definition beyond sales, beyond turnover, beyond gross receipts, then I have to add all other receipts also, which may include certain others, maybe receipt of sale of immovable property, because that is also receipt when it comes to a balance sheet. Then maybe certain loan receipts. If I go to interpret that, then my receipts may become such a big, my denominator may become such a big. Sometimes it may, instead of 5 crores turnover, I may have a receipts of transaction of 10 crores or 20 crores. And my 1% of cash sales would not be falling within the 5% limit, and I still will be eligible out of the audit. So according to me, that cannot be your objectives. Plus, if I include all such receipts, I can arrange my transactions in such a manner where I can do a particular transaction in a manner whereby increasing my aggregate of total receipts to a certain extent in such a manner that my 5% of my total cash receipts always remains within the 5%. So I think so that cannot be an objective. The objective behind the 44AB is always to determine the correct computation of total income, the impact which the items which impact the profit and loss. So profit and loss includes my income side and my expenditure side. On an income side, if you see the main section before the proviso has come, talks of sales, gross receipts, and turnover. So my 5%, when I'm applying this 5%, according to me, in my view, we should restrict it to purely sales, gross turnover, and receipts only, as we have been doing for the purpose of 1 crore turnover also. For the purposes, what includes in sales, what includes in turnover, what is in gross receipts. We have a very big, good literature, which I'll cover in 3 to 4 slides, which is nothing but an excerpts from our guidance note. So while applying this 5% cash receipts on the both sides, the numerator as well as denominator, I would suggest to restrict it only to a sales, turnover, and gross receipts. In my view, it's a very clear. Similarly, when I go on an expenditure side, which also again qualifies the word incurred during the year. So now this takes me to one more step ahead, that if the 5% of the cash payments of the total expenditure is incurred during the year, So there could be a criteria where there could be a situation where the expenditure has been incurred during the year, but it has not been paid during the year. It has been paid in the next year. So what happens? Does this section actually envisage for me to prepare a profit and loss account on a cash basis or a balance sheet on cash basis just to determine whether I actually fall under the audit limit or not? According to me, that cannot be the objective. The objective is very clear. Out of the total expenditure which has been incurred, irrespective the payments have been made either in check or cash or no payments have been made, and I am claiming those expenditure as a deduction under the Income Tax Act between Section 28 to Section 43. If I am claiming those expenditure, I apply this condition on that, those expenditures, that whether out of those expenditure, my cash payments for those expenditures should be 5% off. If my cash payment is out of, if I incur expenditure of 1 crore for an example, my cash payment is 5 crore, for example, only 3 lakh rupees. So balance 97 lakhs. My numerator in this case is obviously cash, so it's obviously 3. And I'm dividing it by 100 because my expenditure is 100, which comes to 3%. Out of this 97, there may be a situation, a certain expenditure I would have not made any payment during that particular year. I have incurred during that year. So whether only because I have incurred, but it does not fall in the payment. So to the extent the amounts are appearing as a creditor, I should reduce while calculating the percentage. To my mind, we should not do that. So in my view, clear view, what I have in my mind is that it should be incurred during the year. So if it is incurred, it will appear in my P&L. Then I calculate my cash payments during the year and I apply that ratio to the total expenditure which I have claimed. That's what would be the wholesome view which I would like to tell. We can take the questions on this in last. Now coming to 44 AD, before 44 AD, as you are aware, section 6%, and if your turnover is below 2 crores, you are eligible to offer tax on presumptive business. Now, if you remember over here when we are actually comparing this interpretation, it's very important to ascertain over here also. It says you have to offer for tax 8% of the turnover and 6% of the turnover. Now, 6% of turnover is which is received by account pay check, bank draft, or ECS, or before during the due date of filing the return of income. So, in this case also, it said that you have to calculate actually the payments received in the bank and then apply 6%. Balance will be automatically 8%. Balance situation may be that you would have not received any money up to the date of filing the return. So, datas are there on 31st March 20. When you are signing the audit report on 30th September, you have not received that money, but it will go another 8%. It's very clear. And only if you have received it by account pay check before due date of filing the return. So you have to also look into the next 6 months. Then you offer it for the 6%. So when applying 6% or 8%, the main criteria which has been taken is income accrued in that particular year. So accrual basis always remains this. So if I apply, so if I apply the similar logic over here, accrual is the most important point. Either it's of an income or expenditure. And whatever is the cash payment of 5% amount, I would compare it with the accrual of income and accrual of the expenditure. Rather than when those income is actually received and when those expenditure is actually incurred. Coming to how to calculate gross receipt on turnover, because this wordings of sales, gross receipts and turnover is since when the tax audit came in, and we have a guidance note published by ICAI on this, which actually details how to be calculated. I'll try to cover one by one on this. In case of professionals, gross receipt include all receipts arising from carrying on a profession. If a profession collects out-of-pocket expenses separately, they shall not form part of gross receipts. However, if these expenses are recovered collectively by way of consolidated fees, whole amount would form part of gross receipts. So, in case of audit fees, where we are collecting, if the arrangement is that inclusive of all of pocket out-of-pocket expenses, my audit fees is 1,10,000. Otherwise, it would have been 1 lakh, but it is inclusive. So my gross receipts become 1,10,000 because there is no separate collection towards out-of-pocket expenses. But if it is different, obviously it will not fall under the gross receipts because I would be also raising a separate invoice for the audit fees as well as out-of-pocket expenses. All advances received for services which are yet to be rendered shall not form part of gross receipts if the services are rendered. So again, advances are not formed. We are following an accrual basis over here. Let's take an example. In case of professional, we all are following cash basis, but still advances are not being considered because advances, only because I'm following a cash basis, the cash receipt does not become my income. It remains a liability. If I'm not done an audit, it remains a liability which is a refundable. Only because I'm following a cash basis, it does not changes the nature of receipt. Liability shall remain a liability and receipt income shall remain the nature of the income. So advances will never be considered if the services are not provided even under the cash basis system. In case of agents, commission is the turnover. If sales tax and excess duty are included in the sale price, no adjustment in respect thereof should be made for considering the quantum of turnover. Trade discounts, quantum of turnover, similarly it applies to the GST today. Somewhere still the excess duty is applicable, and that's why I've covered this. Trade discounts can be deducted from sales, but not commission allowed to the third parties. So trade discounts, which are mentioned on the invoice itself, can be discounted. Cash discount, otherwise than allowed, discount allowed in sales invoice will reduce the sale price and therefore the same can be deducted. Whereas cash discount, otherwise than allowed in cash memo sales invoice, is the nature of financing charge and is not related to turnover. So the trade discounts we are reducing from sales, and therefore for the purpose of turnover under the income tax also that will be reduced. That is trade discount or discount allowed, which is mentioned in this invoice. But cash discount cannot be reduced for purpose of determining the turnover. Turnover will remain gross. Sale proceeds of fixed assets would not form part of turnover since these are not held for resale. Similarly, sale proceeds of investments will not form part of turnover because I am holding it as investment. In case of the company which is engaged in the business of securities or shares, and those shares are classified as stock in trade, in which case only the sale proceeds of those particular shares would be treated as the turnover. But if you're classifying in your balance sheet that as an investment, it will not be classified. Turnover discount is normally allowed. Turnover discount is normally allowed to customer if sales made to him exceed a particular quantity. So if during a particular year there is a if a customer takes a particular threshold quantity, then is as per the trade practice is allowed a turnover discount. Question arises whether I should deduce that for the purpose of the turnover. This been dependent on as per the trade. If it is in nature of trade discount, then it should be deducted from figure of turnover if the same is allowed at periodic intervals. For this, I think so we should go ahead to the erstwhile VAT law and GST law also, which says that if the trade at the time of making the sale, if the turnover quantity discount was known to the customer, you can reduce it from the sales. So similar definition will apply as far as income tax is concerned also. If the turnover or the quantity discount, though allowed at end of the year, but it is known when the sales is made, should be reduced from the turnover for the purposes of input. Special rebate allowed to a customer can be deducted from sales if it is in nature of trade discount. If it is in nature of commission on sales, same cannot be deducted. So any discounts, any rebates, if it can be akin to a trade discount means if either it is given in invoice or he is aware of such discount when you are making the sale, would be trade discount. Sales return. Price of goods returned should be deducted from the figure of turnover, even if the returns are from the sales made in earlier years. So sales return has to be reduced from the sales, even if the sales was booked in the previous earlier years. Sale proceeds of property held as investment property will not form part of turnover. Very clear, immovable property will not be held. Sale proceeds of any share securities we have already discussed. Only if it is in stock in trade, it will form part of turnover, otherwise not. For the purpose of speculative transactions, just concentrating on shares, securities, and derivatives for the purpose of speculative transactions. In the speculative transactions means where the contract for sale or purchase, which is entered into, is not completed by giving or receiving delivery so as to result in sale as per value of contract. In case of such a necessity, undertaking speculative transactions, there can be both positive and negative differences arising by settlement of various such contracts. Accordingly, the aggregate of both positive and negative differences to be considered as turnover. So in a speculative transactions, I may sell securities worth 1 lakh rupees today and buy it immediately without resulting into delivery, or I may buy first and sell it whatever it is in a particular day without entering into a delivery, and there is a difference of 10,000 which I make a profit. So this 10,000 will only be treated as the turnover, not 1 lakh rupees sale value will not be treated as my turnover because it's a speculative transaction. Now, in this 1 lakh transaction, if I buy for 1 lakh, I sell it for 90,000 only without resulting into a delivery. So I have a loss of 10,000. Now, this loss will also be treated as a turnover. So if I do such a transactions over a year, there may be many such 10,000 profit transactions, many such 10,000 loss transactions. If I net it out, it may be a very small profit or loss end of the day. But for purpose of calculating turnover, we will have to aggregate all such profits and losses. So aggregation of profit and losses means I have to ignore the minus figure. I have to consider the loss also as a part of turnover and profit also as part of turnover and add it together to derive at the turnover. The similar will apply in case of derivatives and F&O transactions also, where a transaction, the net transaction of an F&O is either positive or negative, either it is a favorable or unfavorable. You have to aggregate those favorable and unfavorable transactions to arrive at the particulars of transactions. Only in a delivery-based transactions, the total value of sales is to be considered as turnover. So, coming to, I have tried to cover whatever the amendments of the 44AB was there, and what could be an interpretation in my view for the purposes of arriving at the 5 crores limit on the 5% turnover. We can take the questions on this before we move on to the tax audit other clauses also. If feel or we may continue whatever Anurag may have stated.
We can have a question answer session right now.
Yeah, because this is the hot. That's why I thought rather than going into another clauses, if we can try to resolve on this, because I am sure lot of people would have a different views on this. Yes.
In case of a person who is having a general business income and a commission income, whether he is out of the purview of 44AD or he'll remain 44AD for general business and regular in commission business.
He will remain in 4480 for the general business income. For the commission, 4480 is not permitted for the commission income. But for the general other business income, if his turnover from the general business income is say less than 2 crores, so he can offer for that particular business under 4480.
Because under the definition clause of eligible assessee,
yes,
the Act has written regular income and commission income, something like that. I'm not having the Act right now.
See, there is also a conservative, there is also a view which states that the commission is a 2 different businesses. So once I have let's take an example, I am a property concern. I am engaged into 2 different businesses. If I have 2 different businesses, I have to do 2 different tax audits. I have to do 2 different tax audits also. For the purpose of doing 2 different tax audits, like let's take an example of one particular business is falling within the 4480 because all these limits are per business. It's a per business, it's not per assessee. So that's why, according to me, it should not happen that way.
In earlier 44AF,
yes,
there was a business per business applicability, but in this current 4480, I think there is nothing like that per business. It is a composite overall.
I do appreciate there's no per business when the 4480 was included, but the main purpose of excluding commission from a 4480. So once you say of eligible business, so eligible business cannot be the addition of the 2 business. That cannot be the objective. And there are various judgments. If you go into the precedents, there has been it has some objective of this particular is to apply to a particular business. You may not club it, though the 4480 has created a confusion in this matter. So my view strongly remains, still you would be eligible for 4480 for a business which is an eligible business under a particular category, and you have to exclude commission which has to be offered under the business.
Okay.
Yes.
Members,
yes, Anurag, we can. Yes.
members can raise their query on the subject we have discussed. I think we should move ahead and take the query.
Yes. Because there are a lot of queries on the chat, but of course I would not be positioned right now to cover on those. Or if Anurag, you can help me on that, then we can cover it if it can be submission. So I'll move ahead on the other points. On this other things also we'll discuss it.
I will compile that.
Yes, please. Yeah, you can compile meanwhile. Yes, sure.
You can move. I will compile and ask the question.
Yes, I am moving. Now coming to a tax audit, which is of course it has been so many years now. Coming to this, I have tried to comply with the. I've always compiled certain critical issues which, according to me, needs to be taken care of and which needs a discussion. The general things, because the audit is since more than 30 years now. So the procedure as for the auditor and assessee, we know what to be done. So this is just for the purpose of refreshing what is the procedure when we are doing a tax audit under section 44A. Due date of tax audit. A person covered by section 44 should get his account audited and should obtain the audit report on or before 30th September of the relevant assessment year. Now I would like to point out here that if you remember during the budget 20 from assessment year 2021, which is applicable for financial year 19, there was an amendment made which stated that 44 AB audit reports should be filed before 1 month of due date prescribed for the filing of income tax return. Accordingly, the income tax return and the tax audit which was that to be filed on 30th September has been actually been extended by the budget itself. I'm not talking of COVID right now. Has been extended to 31st October. So income tax return due date was extended to 31st October for the purpose for the persons who required to get their accounts audited under any statute. Now, the due date prescribed for 44AB was 1 month prior to due date for the prescribed under section 139. So due date of section 44AB remained at 30th September, whereas the due date for filing the return was 31st October. Unlike the previous assessment year, this assessment year, which is financial year 1920, assessment year 2021, our due dates are 30th September for audit and 31st October for return in case of audit. Now, because of and for transfer pricing where audit is applicable, it was 30th November basically, both for filing the report as well as for filing the return. Now, after the COVID, these dates have been changed. It has been extended. Income tax return filing has been extended to 30th November. Now, once the income tax return date has been extended to 30th November, obviously the tax audit report also gets extended to 31st October because filing the tax audit report was always 30 days as per the law today it stands. Is 30 days prior to 1 month prior to, it's not 30 days, sorry, it's 1 month prior to date of prescribed under income tax report. So your tax audit date will remain 31st October. You need to file your form 360 before 31st October. Returns of those particular assessments can be filed at 30th. The code of ethics, I would just like to touch upon before I move to the clause wise. The code of ethics for the purpose of tax auditor is required to communicate with the previous tax auditor. No need to communicate with the statutory auditor. You have to, whenever you have been appointed for the first time with the tax auditor, NOC is required from the previous tax auditor. Then there is certain disqualifications prescribed under section 288 of the Income Tax Act, wherein you cannot be appointed as tax auditor if you are indebted to assessee or you hold security or you give the guarantee. So this is just to refresh on our codes. Select a limit of tax audit. As we know, it has been now 60. Initially, it has to be 40 for each partner. If the partner has, then it has to be partner wise, it has to be calculated. Accounts not audited under any law, I have already covered in the initial slide that if the accounts are not audited under any other law, then basically a whole balance sheet will have to be audited by the tax auditor himself, and you will issue the report accordingly in 3CB. But if the accounts are audited under any other law, like if it's a private limited company or it's a trust which requires an audit to be carried out under their specific laws, then the report would be issued under 3CA, and you can place the reliance upon those reports issued by the statutory auditors. Only thing what you need to caution is when you are relying upon the report of your statutory auditors, you have to ensure that the disclosures which have been made in the Form 3CD are in line with the disclosures which have been made in the statutory audit reports. In certain cases, like we have related party caro disclosures, which have a similar pattern of disclosure required in Form 3CD also for purpose of 48(2)B. So those cross verification is required to be done. We should ensure that. Auditor also has to note if there is any conflicting impact of accounting standards which have been followed while preparing the statutory audit report or while compiling the audited balance sheet when compared to the ICDS, which are the to be followed while deriving a computation of income. And there is a very specific clause now in tax audit since last 2 to 3 years stating that you have to give a differences between the accounting standards and ICDs. Tax audit forms, form number 3CA and 3CB is the audit report, as earlier mentioned. 3CA where the audit has been carried out under other statute, 3CB when it has not been carried out under statute. Both would be annexed with Form 3CB. Form 3CA, 3CB again is the format. Only addition which has happened is UDI since last year. We have to report our UDI number also, which is generated for the purpose of 3CA and 3CB. 3CD overview, basically we have, it's divided into Part A and Part B. There are Part A which is the important clauses which gives only the details of the assessee, name, address and everything. And Part B are the important clauses which reports about the various parameters of income and expenditure. Now I'm trying to cover the important clause of tax audit form 3CD. I have not covered all the clauses. I have tried to cover the clauses which, according to me, I feel we must retaliate at every point of time, and also we need to be updated on the income tax law when we are reporting in those particular clauses. The first clause is in regard to clause number 16, which I would like to discuss. The clause 16 of the tax audit report, that is form 3CD, deals with amounts not credited to profit and loss account. So there may be an items which have not been credited to profit and loss account, but is the nature of items which is from A to E needs to be reported in this process. It has been largely seen by me, hardly any reporting takes place over here, because the reason may be that if it is in nature of income, obviously as an auditor, I'm already, when I'm drawing the audited accounts, I would be already crediting to profit and loss accounts. So there would be hardly any items of this nature which I would have not been credited to profit and loss account. But there may be a certain scenario wherein the incomes, it falls within the definition of the income, but as per certain accounting standards or as per the management's view, it is like a capital receipt which is not to be credited to profit and loss account. We have to report under this particular transactions. Clause 16B, if you see, will pro forma credits, drawbacks, refund of duty of customs, excise or service tax, or refund of sales tax or value-added tax, where such credit, drawbacks or refunds are admitted as due by the authorities concerned. So once it is admitted by due, and if you are not actually accruing, that means you are not credited to profit and loss account. And there is an order stating that yes, refund is due, it has to be reported over here. Now, clause 60B includes all such undisputed credits only from GST, CD, VAT, and service tax. Now, the question arises, what happens if I'm following a cash basis accounting, whether this has to be reported? If cash system is followed, obviously you will not accrue it because you have not received the refund. But if you are following an accrual basis, you will already have credited to profit and loss account, because under an accrual basis, once it has been admitted as due to you, if there is a refund order, though the refund has not been received. Let's take an example. GST refund is determined on particular 31st March itself, when you know, when you're filing the return, you audit that GST RFD has been filed later on and refund is already due to me. Obviously, you will show as a refund receivable and you will not expense it out. You account it in the next year. But the question is, when I follow the cash system of accounting, according to me, you are not required to actually show it as an accrual basis. You can actually postpone that delivery. And it will not be required, because once it is not being credited to P&L, you are also may not reporting is to be allowed under this clause. Clause 17, a very important clause again. There are a lot of issues in this. Where any land or building or both was transferred during the previous year for a consideration of value adopted or assessee or assessable by any authority of state government for the purpose of stamp duty as per 43C or 50C. Now 50C applies to an assessee who is holding that particular asset under the investments as a property investments or as an asset, and not as a stock in trade. Whereas 43CA applies to a particular assessee is holding that particular land, building or both under a stock in trade. 43CA came to the statute later on, but it was always under 50C, it was always there. So if the property is transferred during the year, that is land, building or both, and if the consideration received is consideration, that is the transaction value is less than the provisions of that particular section, you are supposed to report under clause 17. What it is applicable to? Clause 17 is specifically applicable to land, building or both is transferred for a consideration less than value adapted or assessed or assessable. Auditor is required to report in tax audit. Now there is a lot of controversy on land, building and both, what it should include, what it should not include, and therefore it becomes very important for auditor to also judge it from the tax perspective also, and the judgments which are coming on this while assessing or while reporting under this particular transactions. A second issue that may arise, sometimes the immovable property, because I am doing an audit of a business transactions. A proprietor may have his personal books of accounts and he may be selling those, he may be maintaining those land, building in his personal books. So whether the question is, if it is not appearing in the business books, whether I am required to report under section 43C or 50C, all those transactions which have happened in personal books of accounts, because I am actually auditing the business books, I am not covering the personal books. So I'll just in next 2 or 3 slides, I will try to address those. Transfer of asset held as stock in trade, 43CA, you have to report it. Transfer of capital asset, section 50C. Now, what it constitutes a capital asset under section 50C, we have to have our professional judgment on that. Now, as I said, this clause is applicable to land, building or both. Now we have a lot of lands which are leasehold lands under GIDC. In Maharashtra, we have MIDC. The question arises that whether the transfer of leasehold rights, section 50C or 43CA will at all be applicable. For which there is a judgment of Greenfield Hotels and Estate Private Limited, which says that 50C would not be applicable to transfer of leasehold rights. Now that means if I'm transferring a GIDC leasehold rights to third party, which is the local stamp authority is treating it as a conveyance, he is recovering a stamp duty of a conveyance. He does not treat it as a leasehold rights. Whether I still, as an auditor, of course, these are the judgments ultimately. So the question arises to my mind, as an auditor, what happens? Should I report under the clause 17 or not? The question is, the clause 17 requires land, building or both. Whether the leasehold rights can be treated as akin to a land or building. By the support of this particular judgment, and there are many more such judgments, but says that leasehold rights is not equivalent to land, building and both, and therefore it is not covered by 56. So if the transfer is happening of a leasehold right, to my mind, we did not report it under the clause 17 of section 50 for the purpose of 50C. Even if there is a variation as per the 50C, which is more than 10% value as per the Stamp Duty Act and so on and so forth, then also we will not report. The second question will arise. Tribunal, there is one more decision in case of Atul Puranik, again a Mumbai tribunal, which also talks of leasehold rights. So if these three judgments are analyzed, it clearly excludes all the leasehold rights as far as reporting, as far as applicability of 50C is concerned. And as an auditor, I can go today on this basis. I can also mention in my observations that the transfer of leasehold rights have not been considered for the purpose of reporting under the clause 17 in view of the following judgments. Coming to, there are certain rights when there is, we do find in the major cities and major metro cities that the lands are encumbered. It's in such a situation that the landowner may have a land rights, but he is not in possession of those particular rights. That may be because those are encumbered lands. Encumbered lands in the sense it is completely occupied by tenants. It is completely occupied by slum dwellers. Practically speaking, I do not have a possession. When I'm selling or transferring those rights, I'm not in position to put the buyer of that particular rights into a position. The question again arises would still I would be again reporting under section 50C if I'm transferring such rights. The time and again the various courts have held that section 50C and 43CA is a dimming provision. And the dimming provision should be just interpreted in a manner and its implementation should be restricted only for the purpose which it is. Now the 43CA 50C clearly says it is for land, building or both. If you cannot transfer or if you cannot give the possession of that particular land or building to the transferee, to my mind, it will not amount to the transfer of land, building or both. It is only a right in a land or a building. Though my name is appearing in the property card, because I'm not able to transfer the possession, therefore, what I am transferring is right into a land rather than a land. So right in a land is different than the land itself. Right in a property is a different in the property itself. And therefore, the rights are not covered, only 50C is covered. So the question, obviously, these are the matters of litigation which is happening. For an auditor, if I am to take a view, whether I should just for sake of reporting, whether I should report or I should not report. To my mind, once a 50C is not applicable and there is a judicial precedence to it, you are not obliged to report on it. But as a matter of abundant caution, if some auditor feels, no, I should give the basis why I'm not reporting it, why there is a different view which is arising, then I may give it in the observation. But when I'm following a judicial precedence, the question is there is no difference. There is no contrary judgments to an extent to which I require to give my pivot in the observations. And therefore, according to me, we may not cover it, we should not give it. The second question arises is, supposing actually I'm selling a building and the difference between the stamp duty and the transaction value is within the permissible limit. So still should I report it? So if I've sold the asset for 1 crore, stamp duty value is 1 crore 3 lakhs, which is 5% or 10% now. So it is within the permissible difference of 5%, whether I should do a reporting. According to me, clause 17 requires that wherever there is a difference, you need to report it. So once 50C is applicable, you need to report it. Irrespective, though that difference, there won't be any addition to income because the difference is within the permissible. So if 50C becomes applicable once, the reporting happens. But if 50C is not applicable, the reporting does not happen. I had pointed out one more issue which I would like to discuss is the lands and building, as I mentioned, is kept in the personal books of accounts. There are 2 books of accounts for a particular proprietor. He has his business books of XYZ trading entity, and he has his own personal books. Now, if certain land or building are maintained in the personal books, am I obliged to audit those and actually report any transactions happening in nature of 50C in my 3CB audit report? According to me, when you are auditing, as I mentioned very earlier, that 44 applies to a particular business. I am doing an audit of a particular business. I am auditing the books of a particular business. So my liability to report, my obligation to report under that particular 3CB is in respect of that particular business. I am not going to audit his personal books. If I do not audit his personal books, whether I am required to report those particular transactions in tax audit, to my mind, no. There may be a certain, let's take an example. I would extend this beyond 50C also. If there are certain loan transactions happening in my personal books, which are not nothing to do with the business. I may have a personal capital, which I'm either investing in shares, I'm giving a loan to somebody, I keep giving loans, I keep taking repayments. Whether as an auditor, I am obliged to look into those books. According to me, you are not required to, because I will do an audit of that business. So all this will apply across the board of the Income Tax Act. I will restrict my reporting only to a business books. Clause 18, particulars of depreciation. As we all know, we have to give a depreciation details, but I thought I will need to discuss some important issues which have come on calculation of depreciation, and a lot of time there is auditors may have to take a call on this. The first issue is regarding allowability of depreciation. Whatever you report in tax audit as a depreciation allowable, technically what happens in today's time, the calculation is again done in the computation and ITR. And at the back end, the verification is also being done by the Bangalore CBC. And if there is a difference, sometimes those differences are actually reported in 1.31. That depreciation calculated by auditor is X. Depreciation calculated in ITR is Y. There is a difference. So I will disallow it, I will not allow it, and they make a prima facie adjustments under 1.23. Now, the issue why this may allow sometimes, let's take an example. Under the Companies Act, you have to report all the assets which are not held in the name of the company. Let's take an example of vehicle. This has been happening since long. The vehicles are acquired by the directors or shareholders in their personal name just to save certain RTOs. And they do not actually acquire it in name of the company. So under the Companies Act, when you are drawing a balance sheet, obviously I'm sure that you would be reporting that this all particular assets are not held in the name of the assessee. So question arose, and there were a lot of disputes that whether the depreciation would be allowed in this particular case when the asset is not particularly registered. So this issue, like vehicle, is the most important. In case of Mysore Minerals, though there was no vehicle in that process, Mysore Minerals, Supreme Court has held that when it talks of ownership of asset for the purpose of depreciation, ownership has to be given a very wider meaning. Anyone in the possession of property and who has paid for the property and who has right to occupy the property will be entitled to owner, will become an owner under the TP Act, and therefore he will be entitled to a depreciation. So even if the asset is not owned by is not in the name of an individual company or in the firm's name or in the proprietary concern's name, I can still claim a depreciation and should be allowed. The similar question was, there are other disputed issues, that whether depreciation is available for period for plant which was not in use. Because if you see the provisions of section 32, it says use for the business. It should be owned by the assessee and used for the business. Now plant was closed during the COVID period. So what will happen? I was not using that particular asset during a particular 2 months period or 3 months period. Initially, there were a lot of disputes that were happening in this case, where the factories were closed because of union problems for 2 months or 3 months, and those machineries were not used. So the assessing officers started making additions that you are not complying with the provisions of section 52, which requires ownership and use for the purpose of business. During this 9 months or 12 months, it has not been used for the purpose of business due to lockout, due to factory. No depreciation will be allowed. There are judgments of Scottish synthetics, and there are many more judgments. And I have just brought in one particular small judgments because that the depreciation would be allowed. So even if it is not as an auditor, even if it is not used for a temporary period, the depreciation will be allowed, number one. Second argument is that, okay, because once the asset forms the part of block of asset, it loses its individual identity. So if I have 100 machineries under plant and machinery, out of that 100 machineries, I may not be using 10 machineries at all since maybe 3 years, 4 years, 5 years. I don't know. Still, my block is being used. Even if a particular machinery in the whole of the block is used, only a single machinery, I will continue to get depreciation because I comply with the provisions of the use. Computer software. There's a dispute that whether the router switches should be classified as computers, whether it should be a capital expenditure or revenue expenditure. there was a lot of issues. I would point it out. The revenue expenditure and capital expenditure in case of computers software has been a lot of litigations. The auditor has to take a view at every point of time that, and test should be whether it is providing enduring benefit, ownership test, and functional test. I remember of this Delhi High Court wherein a view was taken that even if I'm buying a SAP actually does not gives me any increase in my profitability. So once it does not give an increase in profitability, it's a revenue expenditure. So it was allowed as a revenue expenditure. So while applying our audit judgment, the revenue and the capital expenditure, whether it's a revenue or capital, the auditor has to exercise his professional judgments based on the previous. If the softwares are of such a nature which actually increases the benefits or increases the profitability of that particular company, according to me, then only it's a capital or it will remain a revenue. Depreciation on intangible assets. If you don't want to go into litigations, you don't want to claim 40% depreciation on the computer software, if you don't want to claim revenue expenditure, and you capitalize those software as an intangible assets, initially there was an issue whether the intangible assets depreciation would be allowed or not. After goodwill securities, now it is allowed. So software will be also now covered under intangible assets. Plus, there are many other areas which are now covered under intangible assets. So we need to ensure if such expenditure is incurred, they are actually capitalized in the books and the depreciation is claimed under intangible assets rather than charging it as a revenue, which includes goodwill, skill and know-how of labor. If you're buying some skill or know-how from some third-party companies, then if you're buying some brand names, if you're paying some non-corporate fees, or you're buying, then or you're buying some marketing or commercial rights. So all are in nature of this intangible assets, wherein you will be allowed a depreciation and not a revenue expenditure. Though there are contrary views which says that you can go to a revenue expenditure. Then there is a clause 19 which talks of calculation of amounts admissible under section 32 AC to 35E. Now 32 AD is, I would like to, of course this is the last year of 32 AD, wherein if any investment in new plant or machinery is made in notified backward areas. The only issue that comes to my mind is that if the asset is acquired during the year, but the installed in subsequent year, because the due date is March 20, the deduction is available in the year which the asset is installed. Deduction will be allowed in the year which asset is installed. Asset should be acquired and installed during this particular period. So if the asset is acquired by but it is not installed in that particular period. So we need to verify on this and keep this in. Clause 20 again very hardly been reported by somebody. As we know that in the private limited companies, there is a practice of not paying the dividend because there is a double taxation. A corporate entity pays a tax at one place, corporate tax. Hereafter, what is profit distributable, he either pays it as a dividend or he retains in his books of accounts and carry forwards as a retained earnings. The question is, because if I pay it as a dividend, I have to pay a dividend distribution tax during that period of time. Now again, I have to pay a dividend tax in the hands of the individual. And already those profits have been stored. And in the private entity, where the shareholders and the directors are not actually different, management and the shareholders are not different, we generally try to use any other method of paying the amounts to the directors. So like we pay them as a bonus or the commissions. Now 36(1)(2) is a specific provision which requires the auditors to report that whether any bonus or commission has been paid to the directors or an employee, which otherwise would have been payable him as a profits or dividend. So it's an onus casted upon the auditors that you exercise your professional judgment. The amounts which have been paid on bonus or commission to them would otherwise have been payable. So instead of paying as a dividend, you are paying him as a bonus or commission. So it gets a deduction, you get a deduction under it. And he pays tax. So there is only a tax at one particular point. There is no double taxation in one. Now, how do we actually report it? The question arises. How do you actually assess that the bonus or commission is otherwise would have been payable as dividends? There are 2 or 3 tests according to me. The first test is whether this bonus or commission has been paid to all employees or not. Let's take an example. I pay bonus only 20% to the all employees. But who are my shareholder directors? I'm paying 60% bonus to it. So there has to be some reason for it. If you are not able to explain the reason, as an auditor, if you don't have a proper reasoning for it, the obligation arises on you that when all the employees across the board, the bonus was 20%, why the bonus of 60% was given to the shareholder directors? This could be the only analogy that could be drawn in that case, that this otherwise would have been paid as dividend, and you wanted to avoid the dividend tax. So that's why it has been paid a bonus, and therefore reporting should happen under 361. Now the question, of course, while analyzing the second issue will came, of course we can argue that if this bonus is not paid to all shareholder directors, or let's take an example, I have 7 shareholders and the director is only 1. And in that case, if I have a difference in the bonus level between employee and director also, because senior management are entitled to a better bonus, then an auditor can take a view, in my view, that because the shareholders are 7, if I would have to pay the dividend, I would have paid to all the 7, whereas the bonus has gone on to a particular shareholder. So this bonus cannot be said to be in lieu of the profits from dividend, and therefore I do not require 6 months. To decide on this profession, I would like to invite your attention to a judgment of a special bench. Very important judgment it is. And it actually needs to be thought over it whenever we are reporting to ensure that reporting under this clause is correct. But there is a judgment of Dalal Docha Stockbroking Private Limited. What it has held in this judgment? Work payable does not mean that dividend should be statutory or legally payable. Payment of dividend is discretionary and not compulsory. No evidence to show that directors had rendered any extra service for payment of huge commission. Assessee has intent to avoid payment of full taxes. What happened in this case, Dalal Docha? There were 2 shareholders and 2 directors, and they were never paying any particular dividend. Whatever was profit, leaving apart small portion, say 10% or 20% of the profit, 80% of the profits were paid at the year end as a commission to the directors. So the assessing officer said that this is hit by 36.2. These are nothing but in nature of dividend. They have never paid dividend actually. They are paying this by, in lieu of dividend, they are paying a commission to avoid that dividend distribution tax. Matter went up to the tribunal, and a special bench was constituted for this. And therefore, it was held that this was an intention to avoid payment of tax. And this will hit the provisions of 36.2. The commissions paid to the directors is nothing but as good as dividend, and therefore would be disallowed. The commissions paid would be disallowed under 36.2, and it has been disallowed. So, for an auditor, it becomes important to keep this judicial precedence in mind, which gives you an total criteria. What could be the test when we are reporting under section 36.2? We can ensure that. It should be ensured that either certain dividends are paid to all the shareholders. It should not happen that you are not paying dividend and commissions or bonus are paid. Please mind that 36.2 only applies to bonus or commission. It does not apply to salary. It is very clear. There are certain judgments which says that because the wordings are very clear, employee as a bonus or commission. So if you pay salaries or if you want to pay as a higher incremental salary, it will not be hit by 36.2. But if you pay in name of bonus or commission, 36.2 could be attractive. Details of amounts debited to profit and loss account within nature of. So 21A requires you to give the details of expenditure which have been debited to P&L and you have claimed as an expenditure, or you want to claim as an expenditure in computation. Now, requirement over here under 21A is only to give the details. It does not say or it does not cast any obligation on the assessee to add back his computation. It's his task. Now, in this particular case, there are 2 important issues which I would like to bring. One is in regard to club entrance fees and subscriptions. That whether this should be treated as capital personal expenditure or whether it should be allowable expenditure under section 37(1). We have seen a lot of club the company's directors subscribe to the clubs and the membership fees is being paid by the company to take the benefit of taxation. The question arises, it's a one-time payment, it is paid, it's a bigger amount, 5 lakhs, 10 lakhs, it's paid for one-time payment. And only the senior management or only the directors is allowed, which we call a corporate membership. So whether this would be allowed under section 27 or not. Obviously, as an auditor, my duty is just to report under transactions. I am not going beyond that. But at the same time, if as a chartered accountant, because in most of cases nowadays, the person who is doing the tax auditor is also involved in doing completion and filing the returns. There are judgments to the effect which says if you are taking a membership for a corporate member and if you are able to prove that this is for the purpose of business for developing the relations, it would be allowed. I've given just a judgment, but there is a judgments of Gujarat High Court and Mumbai High Court to my mind also in this particular cases. So club expenses can be allowed, but the reporting as far as auditor is concerned, he has to report, he has to give a breakup between the entrance fees and the subscriptions, cost of club services and facilities. So entrance fees is generally a one-time payment, which is quite high sometimes in those clubs. Then there is another penalty or fine for violation of any law for time being enforced. So if any penalties are being paid, this has to be covered under and has to be reported over here. Interest will not be included in the penalties. The penalties prescribed in the particular act will only be covered and reported. Penalty is paid by stockbroker to stock exchange. Whether this would be disallowed, it says yes, because there is some violation of law, and that's why stock exchange it cannot, because there is no law. So it should be is a regular business expenditure and should be allowed. So if it is in nature of penalty which is not covered by a law, if it's only a stock exchange, if it's under SEBI, if you are paying for the violation of the law of a SEBI, then it will be disallowed. It will be allowed. Coming to amounts inadmissible under section 40A, 40A 1A, 1B, 1C. So any payments, there is a huge list which you have to report under section 48. It's a general reporting under section 48 under clause 41B. 40A1 refers to the payments to non-residents on which tax has not been deducted or deducted and paid. 40A1A refers to a resident. Then 1B refers to equalization duty and so on and so forth. So there are many clauses which you have to ensure. I would like to cover the certain important points wherein a lot of precedents have come for reporting under 40A1A. 40A1A, 2A, under rate with 211 clause 2. What does it mean? If assessee fails to deduct TDS, the expense shall be disallowed and he shall be treated as assessee in this one. What if payer has taken income while computing total income and has paid tax here on? What happens is, so because if assessee complies with 211, then he shall not be treated as assessee in default. Thus expenses will be allowed as deducting computing income. What is happening is, when the auditor is reporting any particular disallowance under 40A1 and TDS is not deducted under 40A1, you are reporting a particular figure for the disallowance. But what it says that if you are not an assessee in default, there is an explanation to 40A1 which says if you are not an assessee in default, then there won't be any disallowance. For the purposes of assessee in default, you refer to section 201, which says the person to whom the assessee had paid this income, and if he has offered that income in his income tax return, and if he gives a certificate to that discharge, then you will be not treated as assessee in default. And once you are not treated as assessee in default, you are not required to disallow under section 40A bracket 1. So as an auditor, if there is failure of deduction of TDS or there is delay in payment of TDS and due to which some disallowance is happening in 40A, if your client provides you with a detail or proving it or showing it or giving a certificate that the recipient of income has disclosed this in his computation of total income and has paid tax, then you are not required to disclose those figures under 40A1. Though you may be reporting that as far as default of TDS is concerned, in response to a clause where you are giving the TDS charge due to non-deduction, delay deduction, but the same chart or the same whatever amounts have been reported over there may not necessarily result into a disallowance under 40A1 and may not be required to declare. Though I've been seeing that certain auditors, or certain chartered accountants do that, whenever the TDS has been deducted, has not been deducted, because the disallowance is compulsory, it should be reported under 48. So as an auditor, you can take a call, but it is subject to you getting a certificate of, as required under 201, that you will not be an assessee in default because the recipient has paid. Then only you can take that judgment. So these are the conditions of 201A for not being an assessee in default. To protect you from 48, he has furnished return of income, has taken such income from computing income, has paid due tax on such income. So if you take a certificate from the recipient of the income, then there is no need to make a disallowance under section 48. For the purpose of which you have to take a certificate from accountant of a recipient in form 26A. Then there is a amount of deduction in dismissal in terms of section 14A. Section 14A deals with an expenditure incurred in relation to income not included in total income. So if there is an expenditure incurred in relation to income not included in total income, you have to report over that. I will just briefly first read out the important 14A provisions, which says, if the expenditure incurred in relation to income not included in total income, satisfaction of assessing officer must as to correctness of claim of assessing. So if I am reporting any figure or I am not reporting any figure under 14A, the satisfaction of AO has to be recorded. No disallowance of interest where sufficient own funds and non-interest bearing funds are available. Investment made from own funds, interest attributed to borrowings relates to the taxable income to be excluded. Net interest, these are important points which need to be considered if you are reporting on 80. Net interest to be considered for disallowance in the rule 80. Investments from which no exempt income has been earned should be excluded while computing disallowance per 80. No disallowance can be made if no exempt income earned. Disallowance cannot exceed exempt income of the lender. Now the question that arises is, when as an auditor, whether you are required to give a working under 80, we have a very different view under that. 80 applies actually to the assessing officer. Under section 14A bracket 1, it is the onus upon the assessing to satisfy the assessing officer that there is no expenditure incurred in relation to income not included in total income. If assessing officer is satisfied, matter gets over, there won't be any disallowance. If he is not satisfied, then he moves to section subclause 2 and he has to apply rule 8B for the purpose of disallowance. Generally, what is happening is, and we have been advised also, that we actually do a working of rule 8B and give it in the tax audit report. To my mind, if an auditor is of an opinion that there is no expenditure which has been incurred for earning any income, or there are this 5 or 6 criteria, you don't have any exempt income. So where you don't have any expenditure, exempt income, technically no expenditure should be disallowed. There are judgments to that effect. So in such cases, you are not supposed to make any disallowance or report any disallowance under section 14. And for the purpose of which you did not give a working under 80 also. But it is happening in a lot of cases. Though we know that there is no expenditure incurred, but we are actually giving a working under 80, and the assessing officer does nothing during the assessment. He just picks up a working under 80 and makes a disallowance. So in my mind, if according to you, if any of these 4 or 5 criteria, because of this, that there is no interest bearing funds has been used for investments, or net interest income and expenditure are net is nothing, net is negative, there is no exempt income earned. All those criteria, if we come to a conclusion as an auditor that no, there cannot be any deduction under section 48, no disallowance under 48, we will need not give a working under rule 80 also. That's the main crux for the auditors. Clause 26. Any sum referred to in section 43 with deduction only on actual payment, the liability for which. So here 43B, you have to give a two-way reporting. The liability in respect of which was pre-existed on the first day of the previous year, but was not allowed in the assessment, so it was disallowed in the previous year. But it is paid during the year and it should be allowed in during the years. So you will report those figures. Plus the liability which has been incurred in the current year. and which has not been paid before the due date of furnishing the return has to be reported, which will be disallowed. So certain deductions are to be allowed on the actual payment. Now, there's an important. This is a very general clause. I would just like to make one point on this in this. Yes. Now, coming to GST, there are certain excess payments of GST lying in electronic cash. The excess payments, in the sense, let's take an example. I made certain payments of GST and it's lying in electronic cash. In my books, it is appearing as a deposit. Now, you paid it by a mistake. The question arises: amounts paid in electronic cash ledger and lying as a debit, whether we can should be reported under 43B and claimed as an expenditure. And when you actually receive the refund, or when you actually adjust it against the particular liability, we should reverse it to the income, whether those benefits can be taken or not. Now, electronic cash ledger is nothing but a deposit. It's a prepayment sort of thing. Now, whether any such payments can be allowed under Section 43B, though it is not against any particular liability. Because if you are making a payment against any particular liability, if you are making it though under protest or a deposit, like as well, we had to, under the service tax, we used to deposit 7.5% or 10%. And those deposits, though in the balance sheet was carried as a deposit, you never used to debit it to profit and loss account. But please, those were allowed under Section 43B. Because 43B clearly says if any duties, taxes will be allowed on the payment basis. So once I am paid, then I will be allowed as a deduction under the 43B. Because otherwise I'm double jeopardized. Because when I'm doing a deposit of this money, the government is using this as money. I'm not debiting it to my expense. I'm carrying it as a deposit because it would be received as a refund. And I'm also losing on 30% tax benefit. So in a way, I would say 100 rupees deposited under the 7, like erstwhile we were doing it under service tax. If I was filing an appeal, I had to pay 7.5% as a deposit. Then only I could have gone in the appeal. Now the 7.5%, you may not make a provision to that extent. If you make a provision to that extent, there is no question 43B will be allowed. But if you do not make a provision, you only carry it as a deposit. The question arose, still, though lying in a deposit, whether I can claim under 43. According to me, it could have been claimed during that moment of time. There was a judgment of Vodafone in case of Delhi, which says that even a Senvet credit balance as an expenditure has claimed Senvet credit balance lying as unutilized can be claimed as an expenditure if they are written off in the books. If those Senvet credit is subsequently reversed, it would be available, would be taxed as income. So similarly, if the payment has been made and if I am not able to recover that cash immediately because I am having a lot of Senvet balances, according to me, you can still claim this as a 43B. Whenever those cash ledger balances is utilized against a liability, it may be offered as income. So at least, even if your cash flow is blocked into the GST, you can take a tax benefit to that extent. Similar, I can give you an example. There has been a lot of issues came up because in the diamond industry, there was a confusion under the GST and they came with a rate of 3% if I'm not wrong. And then it was reduced to 0.25% somewhere in January 2019 or something. Now what happened is 3%, whatever purchases were made prior to January 2019, there was a Senvet GST input tax credit available and the balance in electronic credit ledger was accumulated at the rate of 3%. From the first Feb, from that cutoff date, I don't remember the exact date, from 1st Feb 2019 maybe, I started paying on my output liability at 0.25%. And the stock was created at 3%. So in certain cases, I have seen it, that this electronic balance in this electronic credit ledger has never been utilized. You are not able to utilize. And if I actually do a mathematical calculation, it may sometimes take 3 to 4 years or maybe 10 years to utilize. Because 0.25%, that too on value addition. Because when you are selling something, you are also buying concurrently certain goods. So when you're buying at 0.25, you're selling at 0.25. Roughly, you are paying 0.25 on a value addition, which you can adjust on this 3% accumulated credit, which were purchases made at the old rate. So the question arose that let's forget GST. What remedy you have in GST? Question arose when this Senvet credit is continuing in my books, which may continue for 2 years, 3 years, 4 years down the line, whether I can claim as an expenditure or deduction under Section 43B. to my view, if I go to a modipon, which is the judgment of excise duty, according to me, I can claim it as an expenditure. What I can do is, I can write off this separate credit balance, because there is, in any case as an auditor, it is our duty where you don't have a reasonable plan to reverse that particular asset or realize that particular asset. It's not necessary to carry in the books. So you do not carry in the books and you reverse it to P&L. Whenever it is reversed or whenever it has been adjusted against your liability, you will be offering an income in the future. But as of today, at least what I can do is I can claim this under deduction under 43B. On the reversal, once I am reversing, it's an expenditure. If I am not reversing, then also it would be allowed under 43B because the cash has been paid to the buyer through LA, or it is through electronic cash ledger, or it's through electronic credit ledger. So in my view, you can take. So at least I'm not suffering, though my 100% rupees has been down. At least I get a benefit to the extent of 30% of tax rate, and I am in cash loss only to the extent of 70%. So as an auditor, you may need to have to examine such claims and whether such claims are allowable or not allowable. You may have to be looked at. Clause 29 requires the auditor to report on under section 5627B. Now 5627B states when during the previous year assessee received any consideration for shares which exceeds the fair market value of shares as referred to in section 5627B. You have to state yes or no. If yes, details to be furnished. Now just reporting yes, and it sounds to be a very small job. You have to just say yes or no. Now the 5627B itself is a Bible in itself. Where you have to go into it as an auditor, you have to examine those and whether actually it falls under 5627B or not. You may have to examine it. Now, 5627B applies to the company which public are substantially not interested. It's because it applies to basically a private entity. So in which the public are substantially interested, it does not apply. So which are the publics which are substantially interested is public company, listed public company which is subsidiary of listed company, private company which is subsidiary of listed public company. Those are all the public companies, public limited company not listed. So these are exceptions. Again, then there is exemptions under 5627B. So it does not apply to this particular category also, where the subscriber to shareholder is a non-resident. So if the subscriber, if the company has issued the shares, though it may be at the value in excess of fair market value, but it is issued to a non-resident, then the 5627B does not apply. If it has been issued to a share capital, a venture capital undertaking, or a venture capital fund, or a company, or alternative investment fund, it does not apply. This basically has been given exemption to startups. So in this cases, again, it does not apply. Or industry is a startup company which is registered under, recognized by DIP, Department of Industrial Policy, then also it does not apply. So in such cases, wherever the assessee who is the auditee, in whose case the share capital has been issued, if it is issued to these three categories, then 5627B does not apply. As an auditor, we need to ensure that if 5627B applies, then whether the valuation has been carried out or not. So wherever the shares have been issued, it becomes the utmost duty of the auditor to demand and valuation report. Because if the valuation report based on which fair market value will be determined, valuation has to be carried out in accordance with 11U and 11UA. It's a duty on the auditor to report on the applicability of 7B or whether it is 5627B is triggering, yes or no, which you cannot do without obtaining a valuation report. Valuation report to be issued by merchant banker. Of course, chartered accountants cannot issue unless they are the registered value, so or they are not an auditors. So there is some certain restriction which has come in the Tax Act. So the auditor will have to ensure that all these particular cases are being followed and have to take it on record based on its professional judgment, have to report to this question that whether 5627B is issue of exceeds the fair market value or not. So for determining the fair market value, we'll have to insist our clients that please get a valuation report for the purpose of evidence that fair market value has not been exceeded, and if it is exceeded, then you need to report it. For the purpose of 11U and 11U, you know there is a permitted method which talks of adjusted book value and discounted cash flow. Adjusted book value is, initially there was a book value, now they have replaced it with adjusted book value since last 2 or 3 years. Adjusted book value means that if a particular entity is having a downstream investments into another company, then you have to replace you have to also value those downstream investments and replace it fair market value to arrive at the fair market value of the holding company. Similarly, if you own some immovable property, then the value of the immovable property has to be derived, and that has to be replaced with the book value for the purpose of arriving at adjusted book value. Then there is a DCF. Now, when the question comes, I would also like to point out there are a lot of judicial precedents when it comes to challenging the valuation report, because this valuation report, as an auditor, I would also be relying upon. So when I am relying upon a particular evidence or particular document, it becomes my utmost duty that what is the sanctity of that particular report, whether I can really actually rely upon it, whether the figures which have been reported by the management given to him for DCF are correct or not. As an auditor, obviously you can rely upon the third party, but if those figures are actually been applicable, it becomes our duty, because under the audit we have a guidelines that in what circumstances you can rely upon the third party reports. So you cannot, by closing your eyes, just state that the third party report has been received. As an auditor, you need to look into the third party reports. But when it comes to an assessing officer has a very limited scope as well as, because question arose a lot of times that whether assessing officer can challenge the valuation. According to me, they cannot, because they are not the expert. Assessing officer does not know ABC of the valuation to be done. So he has no authority to do it. But it is happening in the real terms that they will always on some flimsy ground that the projections given have not been achieved, because he would be doing assessment after 2 years, 3 years, and in himself he would realize that the projections have not been achieved, and therefore I reject the valuation. To my mind, it cannot be. They do not have an authority. If they're doing it legally, they are not right. Then there is a similar provisions in 56(2)(9), where amount is to be included as income chargeable under the head income from other sources, as referred to in clause 9 of subsection 2 of 56. Yes or no? So you have to report on the 56(2)(9) of the same. Of course, what does 56(2)(9) subclause 9 requires? It says any sum of money received as an advance in course of negotiation for transfer of capital asset is forfeited, such amount is taxable. So as an auditor, you need to verify all the advances which have been received. You need to put a question to your auditor that what does are in nature of advance. If it is towards the sale of a particular capital asset or a transfer of a capital asset, and if this amounts are being forfeited in books of accounts, then you need to report. So as far as audit is concerned, the compliance arises only when there is a forfeiture. So auditor may receive an advance. He may carry this advance for a long period of time. There is no forfeiture in the books of accounts. The question arises whether I should report under this particular clause or not. Assessing officer may say that it has been forfeited because it become time bar, more than 3 years, these amounts are lying. Why it should not be treated as forfeited in tax under 56(2)(9), whether or not. My question, but as far as when it comes to the auditor's responsibility, according to me, the reporting arises only on forfeiture. If there is no forfeiture, amount continues as an advance, you may not report it. Reporting requirement, it is in respect of personal capital asset, where neither asset nor advance nor forfeiture it is recorded in book. So again, as I said, we had initially discussed, if there are such capital assets against which I have received advances which are lying in personal books of accounts, they are not in my business books, I am obliged to actually report. How would I know? Because I am not auditing those books of accounts. I am not looking into the bank statements of the personal or savings account wherein such advances would have received. And assessee would not like to disclose it. Even he would have said it, all money would have received, but he doesn't want to show income, does not pay tax. He carries us in advances. What happens? According to me, if it is reported, if it is in personal capital books, I did not report it. If personal capital assets are recorded in my books of account, that is of business, then only it has to be reported. And that also when there is a forfeiture. A mere notice of forfeiture may not amount to forfeiture if no amount is written back by assessee. Reporting is not required. Such reporting is required only in case where amount is written back in books of accounts. So if he is writing it in books of accounts, then only I will report. Mere notice giving that I am forfeiting amount, or there is an agreement MOU drawn, and based on that particular MOU, let's take an example, there was an MOU that he will pay me 20 lakhs and he will pay me within 6 months balance consideration of 80 lakhs out of 1 crore rupees. He does not pay. So my MOU is very clear that automatic 20 lakhs get forfeited. The question arises whether auditor has to look into terms of MOU, though the advance is still lying in the balance sheet, and report it under the SOR. To my mind, though you may insist, because if the actually it would be taxable, because as per the terms, if it is not refundable. But sometimes happen, though your agreement may state this, but the claim of the buyer may not cover, and he may file a legal suit for recovery of the initial amount also. So unless and until assessee actually writes back in the books, to my mind, as an auditor, we need not report it. What if assessee contends that amount has not been forfeited? That's what auditor to look at totality of obtained management representation. Even though contract permits forfeiture or some condition may have occurred, but the assessee has not forfeited the amount. So we may take a condition, we may take a management representation letter from that, stating that the claim of the third party is still claiming, he may say, management may say that the buyer is still claiming that amount. He is not agreeing to the terms of the amount. He says that you have defaulted on certain doables or warranties or representation which generally a seller has to give. So he is not agreeing to a forfeiture, and that's why I'm not doing that. I want to continue. But in such a scenario where MOU says that after 6 months it's applicable forfeiture, as an auditor, what should we do it? For instance, we can, if it has not been forfeited, we cannot force the auditee to actually record the forfeiture, and we may include in this particular column. We can tell them, or we can take a management representation. And if you still feel, based on your professional judgment, it would be ideal to disclose this in an observation, stating that as per the terms of agreement, this is would have been forfeiture, but the assessee has not forfeited the amount, and therefore no reporting is done in the process. Coming to 56.2.7. Now 56.2.10 technically is a replacement of 56.2.7a. There was initially 7a clause, the 7b stands. 7a applies to all individual and HQL who used to receive any amount without consideration. Now those after 1st April 2017, 7 and 7a have been clubbed into 56.2.10, and the reporting is required to be made under 56.2.10. What it says, whether any amount is to be included as income chargeable under the head income from other sources as referred into clause 10 of 56, yes or no. If yes, it will be furnished. So you have to give actual details of the income which is needed to be included in the 56.2.10. So as an auditor, you will need to require to go into the provisions of 56.2.10, which actually envisages 3 situations. One is when you are receiving amounts, money in more than 50,000 without the consideration. So gifts received more than 50,000 are taxable, unless there are exemptions of relatives, which we all are aware. Any immovable property without consideration, or with a consideration which is, there is a difference between the stamp value and the consideration of more than 50,000, then the section 56.2.10 would be applicable. Now you need to report again similar to 50C. We have discussed largely in this case when the 50C was there, that if I am selling a particular asset and there is a difference between the stamp duty value and the transaction value, you need to report it. Similar reporting will happen in case of 56.2.10, where I am buying the immovable property. This is only a reversal. That was in case of seller, but this is in case of buyer. So if I am buying a property which has a stamp duty value of 1 crore rupees, and I am buying it for 90 lakhs, then auditor is required to report this 10 lakh rupees as chargeable to income tax under this particular clause 29B. Now the question arises, if you read 29B actually, and this text, it clearly says you have to say what is amount to be included. Whereas technically only because there is a difference between transaction value and stamp duty value, it does not become income of under 56.2.10. Because assessee has all the power to rebut the claim, rebut the stamp duty value. He can refer this matter to the DVO. He can also fight on that the stamp duty value is not correct. He can go to the courts challenging the stamp duty value. But as far as auditor's duty is concerned, is a reporting, and once you report into that, all possibility that it would be the assessing officer will make adjustment, and they may have to dispute or they may have to refer the matter to review and then a bit of time. Unlike section 50C, which talks of land, building or movable, it talks of any movable property over here. So here it does not talk of land, building or both. It talks of immovable property and property other than immovable property. So 56 to 10 technically applies to all other rights in the capital asset also. Shares also, everything, because it's quite wide. It's immovable property, which will be land and building, property other than immovable, so rights in land, rights in building, encumbered land, leasehold lands also can be treated as property. It's a property other than immovable. So in those cases also we have to determine. So by before reporting, because in case of property other than immovable property, there may be a conveyance deed happening, but there is no stamp market value. You need to determine a fair market value. So again, whenever there is sale or a transfer of or purchase of, in this case, purchase of property other than immovable property. Let's take an example. I have acquired goodwill, I have acquired a brand name, I have acquired equity shares of a particular private limited company. So auditor will have to insist upon the valuation of those fair market value, that how this fair market value is determined. And if there is a difference of fair market value and the actual consideration of more than 50,000, then you have to do a reporting over that. Again, fair market value has to be determined by as per the valuation report in case of immovable property also, and in case of other assets also. Again, rule 11U and 11UA will apply, wherein the valuation of the shares would have to be carried out on the similar method, which we have already considered in 5627. I'll just keep on this. This is the calculation which has been prescribed in the 11UA, which is relevant for all these particular sections. And of course, the valuation, we have to rely upon the valuation report, but we have to see that prima facie there is no mistake in the valuation reports, or the projections given by the management are not totally in disregard or does not actually justifiable while considering the previous year's figures. Clause 38, this is, I just try to cover it in limited, because these are applicable only to clients which have a transfer pricing transactions, referred to in 92(1)(CE has been made. It talks of primary adjustment of transfer price, wherein you are required to give the details in this manner. Now what happens is, what 92(CE talks about, it talks of concept of secondary adjustment in certain cases. Supposing there is an international transaction between you and your associated enterprise located outside India. Let's take an example. You have given a loan amount of 100 rupees to the outside associated concern, and you have charged an interest at the rate of 3% only. And transfer pricing adjustment based on, because you are doing a TP audit, you come to an transfer pricing adjustment stating that 3% is not correct. It should be 6% if it is LIBOR plus. If I go based on LIBOR plus, if I go on SBI, it should be 8%. So you come at a conclusion. Let's take an example, 6%. So 3% is a TP adjustment. So you will do a TP adjustment in your transfer pricing audit report of 3CEB. But what does this tax audit report require us? Okay, wherever the primary adjustment has been made, and if the primary adjustment is of more than 1 crore, then this more than 1 crore has to be treated as recoverable from the associated concerns. So if this 3% difference amounts to an interest, amounts to more than 1 crore, then the secondary adjustment has to be done and has to be reported in this particular clause. So those secondary, that is how the excess money will be repatriated, how again interest would be calculated, because that excess remittance of the interest or excess remittance or less remittance or less charge of interest would be treated as if recoverable from them. And once it is recoverable from them, then again you have to actually calculate an interest at the arm's length price and report under 92(CE). So that's basically the secondary adjustment, which is again relation to primary transfer pricing adjustments. So these are the certain things which have to be reported. Where such amount is not required, such balance shall be treated as advance made to and disclosed under clause 38 to be made. Thus, reporting is required in tax audit for financial year 17-18 onwards. Where such amount is not required, such balance shall be treated as advance made to associated enterprise. Interest on such advance shall be computed in manner as may be prescribed. So that's the most important thing. that you have to treat those advances. If that 3% interest is not recovered, it has to be treated as an advance recoverable from them. Though it's just a difference of interest. You have charged 3%, you should have charged 6%. So this 3% will be treated as an advance. And interest on such advance also has to be calculated and reported over there. But please mind the threshold limit of security adjustment is 1 crore rupees. Again, a clause 30B, again, this is again in relation to transfer pricing only, in relation to section 94B. It says section is applying to company having non-resident associated enterprise, where debt is issued by a lender and AE provides guarantee for such debt. Where assessor pays interest to a non-resident associated enterprise in excess of rupees 1 crore, interest allowance shall be restricted to. So if I am paying an interest to a non-resident, if I got an ECB from an associate enterprise, and if I'm paying in excess of rupees 1 crore interest, then I will be allowed interest only to the extent of 30% of my EBITDA. So there is a restriction when you are paying an interest to associate enterprise. Even if you are paying 1 crore rupees in excess of 1 crore, so not 1 crore, if you are paying 2 crore rupees and 30% of EBITDA comes to say 60 lakhs, that interest would be allowed only up to 60 lakhs and then not up to 2 crores. So whichever is lower will be allowed as a deduction. So you need to report under this particular clause. Coming to clause number 31, again 269 ST, most of mode of undertaking transactions. It is in statute since quite now 2 years. 269 ST requires, clause 31 requires you to report that in case of no person shall receive an amount of rupees 2 lakh rupees or more in aggregate from a person in single day, in respect of a single transactions, in respect of transactions related to one particular event. Otherwise, by account pay check or account pay draft or electronic clearing system through a bank account. So, in case I receive any particular amount other than by an account pay check, exceeding rupees 2 lakh rupees or more, with this particular conditions in an aggregate from a person or from particular single transaction. So, if my single transaction is a value of 3 lakh rupees and I receive into particular installment, then also 269 ST gets attracted since a single transaction value is higher. So what happens if I do a netting off? The question arises: the amount payable is set off against amount receivable. I am doing a journal entry. Whether, because such set off is not a receipt, so whether it will 269 is attracted or not, that's a question. So there are two views again, that in case of journal entry, this is not a receipt, so 269 ST should not be applicable. And there are judgments of Delhi High Court which says that 269 SS, it is in relevant to SS&T, where the repayment and acceptance of loan by way of journal entry says that the 269 SS&T should not be applied in case of journal entry transactions. So similar analogy can be drawn to 269 ST, but there is a contrary judgment of Bombay High Court which says that the journal entry should be considered, and it should be considered as violation of SS&T. So similar you can be taken for ST. As an auditor, obviously, my duty is to report the transactions. So if there is a transaction, we have to report. There is a fixed column in an online, whether received by air code. So you have to say yes or no. And obviously, what it asks is whether it has been received otherwise than by account pay check, account pay bank draft, ACS. If it's through journal entry, according to the yes, because it has not been received by any of these methods. Coming to clause 36A to 22E deemed dividend. Now, generally, we have been seeing this as an important clause which most of us do not actually look into it. And because as we had discussed 36(1)(2) in private entities, there is a practice by the companies to keep on advancing the monies to director shareholders. And they will never take it as a salary also. They will, if there is a surplus money lying in the company, they will just take it as a loan. They will not take it as a salary because they don't want to pay salary tax in their hands. They will not take it as a dividend because the dividend tax is applicable. And they will just continue the debit figures as if some advances are being paid. Now, in such a scenario, deemed dividend is applicable. So responsibility is casted upon auditors because deemed dividend has been violated, I am sure, since so many years, and none of the assessing officers have been ever able to locate it. But nowadays, it has been become the flavor of the season. Whenever we go for the assessment, 222 has become the most important. When it becomes a flavor of season, it casts much more obligation on the auditor to report it, because the situation may arise that assessing officer finds out something which we have not reported, and then we have quite an issue of that why it has not been reported. So it can be taken otherwise also sometimes. Now, so it needs to report it to 22E. We need to verify that if I have advance or loan by a company to a shareholder and that shareholder is holding more than 10% of the voting power, you need to report it. If there is some similar advance or loan by the company to a concern, if there's an intercorporate deposit. So my audit company gives a loan to somebody else's company, and I already have a shareholder as a substantial. My shareholders have a substantial interest. That is a common shareholder. Shareholder of my audit company is having more than 20%, and he has a more than 10% voting power and 20% in another concern. Then the 10-20 ratio is happening. So 10% in my company, audit company, and 20% in the company which has obtained loan. Then also it gets covered under 222E. Payment on behalf. So I paid for some individual benefit of the shareholder to some third party. That would also be covered under 222E. As a shareholder, we need to verify all those transactions. It's very difficult because sometimes we may not have an access to a particular entity's books also, and that's why it becomes very difficult. As far as calculation of dividend is concerned, your dividend will be only calculated to the extent of, so if you are distributing or you're giving an advance or loan to more than the accumulated profits, then you would be taxed only to the extent of accumulated profits. If you do not have accumulated profits, only you have received loan from X and you have paid loan to Y, loan to directors or shareholders by taking somebody's loan, then there is no dividend to be deducted. The difficulties which generally auditor has to face and they have to address is how to find out accumulated profit of the parent company. So if I'm paying, let's take an example, I am a recipient of the company. So if any nature is on 222E as a recipient, how would I know from the monies which I received from the holding company or from the person who is covered under 222E, how to calculate accumulated profit? So you have to have access to the parent company's profit and accounts also, though you may not be an auditor. Then you need to calculate possession of accumulated profits on date of transaction. So then the accumulated profits keeps on increasing year by year. So as an auditor, you need to verify that those accumulated profits continue in the hands of the peer company. Because it may happen that those accumulated profits might have been distributed and it may not appear in the reserve, then it's easier. But sometimes it may happen that accumulated profits were already given at advance in the previous year. Because only advances which have been given in the current year can be taxed in the current year, and that needs to be included in this particular clause. So if there is already an opening balance of accumulated profits, and those accumulated profits have been already given as advance, which were in nature of dividend, though not suffer tax. So according to me, any fresh advances given in absence of accumulated profits shall not be reported. Difficulty in identifying the payments made on behalf of the shareholder. Accumulated profits which can be distributed and which cannot be distributed, bifurcation needs to be made. So audit considerations are auditor to obtain certificate from assessee containing list of closely held companies. Just a minute, sir. So as an auditor, you need to obtain the list of closely held companies. Anyways, we are also doing it for the related party transactions. And also you need to take a list of particulars and loans of advances. You can also verify 26 years because if some interest is paid or interest is received, you will come to know about such transactions. And we can inquire into shareholding pattern of those entities, whether they are somehow related to us 10%, 20%. Sometimes we may also have to do a company law search if we have received some ICD from third party company and your assessor says he is not related to me somehow. And when you actually go into, you realize that that company has a common shareholder and my audit company's shareholder is also common. One of the shareholders also having a 20% stake. So we need to also see into all those documents that wherever KYC needs to be done from wherever the company is receiving any particular loan or advance, whether it falls under the criteria of 222E. There are issues involved in 222E. I'll just briefly try to cover up because I will be sharing this. So judgments also will come to you as members. Issues are who is to be taxed, registered shareholder or beneficiary shareholder. So the question arises like as an auditor, if I may be a shareholder, I have received a particular amount my auditee has received a particular amount of which I am a registered shareholder, but I am not a beneficial shareholder, or I am a beneficial shareholder, but I am not a registered. So in case of like an HUF is an entity, and HUF receives some amount as a loan from a company where HUF also is not a registered shareholder, but he has an investment in that particular company by way of 20% or 10%. So what to be done? The Supreme Court has said that although HUF is a beneficial shareholder but cannot be a registered shareholder, shares are issued in which they consider dividend in the hands of HUF. So in short, it will be taxable in the hands of the beneficial shareholder. So if you are an auditor of a beneficial shareholder, though you may not be a registered shareholder, investments are appearing in your books and you receive any advance or loan and you are not declaring as a dividend, not as dividend or as a salary as a direct shareholder, you are only reporting as an advance receipt from that particular investee entity, it would be covered under 222E. The problem arises how to report in case where there is an intercorporate deposit, because see what happens is if company A gives a loan to company B, and those both are related parties because there is a common shareholder. Now taxability arises in hands of A, neither in the hands of A, neither in the hands of B, but it should be taxed in the hands of the common shareholder. Now if you are an auditor of a common shareholder, the problem difficulty arises. I am a proprietary concern. I have a business. I am doing an audit. I have an investment in company A or company B. Now company A and B are doing transactions amongst themselves. How would I know as a common shareholder that I am covered under 222E and I have to include under, I don't know. So only way I can understand is the representations. So just for sake of repetition, if I am a proprietor having certain shares appearing in my business balance sheet, then those shares I hold 20% in company A, 10% in company B. And company A and company B does a transactions which is covered under 222E. Then as a shareholder, technically, I have to report in column clause 36A that this transactions between company A and B is in nature of being dividend, which should be actually taxed in the hands of these shareholder. But when I don't have an access to records of company A, company B, because those are different auditors, I am not an auditor, what happens to that? So it's very difficult in assessing it. Only way I can think is of representation. ICDs are not loans, mobile capital. So if it is an ICD, it's not covered. That's the exemption given to us. There's a mobile capital judgment. Advances made in ordinary course of business are not covered. They cannot be covered. So if it's a business advance, business deposit, they will not be covered in dividends. Transaction in nature of current account are not applicable. So it's a current account transaction between two corporate entities where two corporate entities are in the same building and somebody is paying rent, they are settling the account, they are sharing the rent, they are sharing the electricity. Such current account transactions cannot be covered. There are certain judgments here. Then the clause 42, almost coming to the last part, where the assessor is required to furnish statement in form number 61 or form number 60 or form number. You need to state whether he is required to submit or not. If he is required to submit, if yes, then you have to report that when it was done, what was due date of furnishing, whether it was furnished well in time. Now, the most important is whether the form contains information about all details, furnished transactions which are required to be reported. If not furnished on this. So now you have to actually verify all such transactions. So there may be the question, there may be two scenarios which auditor may have to go into. That first of all, whether form number 61, 61A, 61B is required to be submitted or not based on its nature. If it is required to be submitted and if it is not submitted, you have to report. Number one. Number two, then you have to arrive at those transactions, list out those transactions, why this is applicable, which needed to be reported and has not been reported. So you need to. If he was required and he has reported in form number 61, 61A, 61B, but he has missed out certain transactions, then also you are required to furnish those lists which are not reported. So technically, all these transactions needs to be verified when you are designing your audit process. To whom form number 61, 61A, 61B applies. Now, form 61 applies. Every person is required to put PAN in transactions specified under Rule 114B. The PAN not put in a declaration to be filed in form 60. So when are the PAN to be taken? When the sales is made more than 50,000 in cash, you have to take a PAN. So there is list of transactions under the 114 Rule 114B. You need to look into it. If in all such transactions, wherever it falls, if the PAN has not been obtained by SSC, then he has to report it in form 65. or he has to take a declaration to be filled in Form 60 and report in Form 60. If he has not done, it's an auditor's duty. Similarly, there are certain specified financial transactions which are required to be reported in Form 61A, which are all due dates are prescribed. SFT includes, for the purpose of specified financial transaction for purpose of this clause, includes issue of bonds, issue of shares, buyback of shares. These transactions may not happen every year. Special attention should be given to such transactions. SFT includes receipt of cash payment exceeding rupees 2 lakhs for a sale. Thus, appropriate reporting is required for the sale. So, wherever 2 lakhs reports sale is happening, SFT includes that, which is also a violation of 269 ST also. So SFT, a specified financial transaction, has to be filed, and we need to ensure that it is filed, and if it is not filed, you need to report it. Similarly, 61B includes reporting on FATCA, Foreign Account Tax Compliance Act. The process reports include basically this FATCA may not apply to everybody. It only applies to a certain part of its banking and financial institution. So I'll just keep it. It does not apply to a general entities. Again, there is a clause 43 where the assessee or its parent entity or alternate reported entity is liable to report as referred to in subsection 286. The assessee under section 286, wherever assessee is a part of a particular group or something, or a parent entity is a part of a group, you need to make a report, you need to file a particular alternate reporting entity, and you have to give a response to it. So it's a very specific again. If yes, you have to furnish the following details if you are forming part of that. Whether report has been furnished by assessee or its parent entity or an alternate reporting entity. Name of parent reporting, alternate reporting entity, date of furnishing. So this is again a very specific, it applies. Now question is, who is required to file this report? Parent entity is resident in India or international group has appointed a constituent which is resident to file a report on behalf of the group. So if the parent entity is resident in India, the parent entity is filed. But if you are a part of that particular parent entity group, international group, so if you, it basically applies to multinationals who constitutes an international group, and you're part of that international group, then you need to file it. So it's a very specific, which I will not go into detail. Thank you very much for your patient hearing, and I've tried to cover the major clauses which I felt that it's quite, nowadays it's of prime importance by the assessing officers, and now we can take up the questions and whatever we have.
Sumit was asking some questions here. Sumit, are you there?
Sir, are there any clauses added or deleted in the new Form 3CD?
The new Form 3CD. Hello?
Hello?
Yes, please.
Are there any clauses added or deleted in Form number 3CD?
Certain clauses which are added, I have already covered into that. Yes, please.
Hello. अनुराग जी.
Yes,
सुनील जी बोलिए.
हाँ. Piyush ji, my only question, or which is the most confusing question to all of the chartered accountants.
Yes.
Whether this 44AB, as you mentioned, and that it is applicable business-wise, not SSC-wise. Audit of the business, not of the SSC. And if there is two business, one is eligible under 44AB, may not be. So, if you see the entire scheme of the 44AB audit,
please come back. Please. I can't hear you. Others can mute it. Please go back. You were mentioning entire scheme of 44AB.
Hello.
Yes, Sunil, please. You are maintaining some entire scheme of 44AB.
Yeah. So if you see the entire scheme of the 44AB, right from the form number 3CD, and subsection 4 of section 44AD, and subsection 1 of the 44AB, it all speaks about the person, and which is SSC only. The business is only concerned whether there is a 2 crore turnover or not. That is only business wise. Otherwise, entire thing is to be SSC wise. I am going through the 3CB certificate, we are going to offer, we are providing, that is the for the period from itna to itna, here we name of the SSC and the permanent account number. So it is with the SSC only, not of the business. And then, and what we are writing in the clause number 5 of the 3CB, in my or our opinion, to the best of our information and according to the explanation given to me or us, the particular given in the from 3CD are true and correct, subject to the following observation. So 3CD, whatever observation we are giving, it is on the of the SSC, not of the business. And you see the on number 3CD, there are 16 places where the SSC word has been added. SSC word has been used in 16 places. And 44, you come with the 44 AD also, subsection 4, which speaks about when you have once you have taken the 44 AD1 and you have the subsequent year you have not take the benefit of the,
you have not taken, you have opted out.
Then you will not be eligible in the subsequent 5 years. That here he will not be eligible. SSC will not be eligible, not the business. So once in any business, suppose there are 2 business, one is not eligible under section 44 AD, then the entire thing will not be eligible because he will not be eligible. So where is the distinction?
I'll come to. So basic distinction is the 44 AB applies to a particular business as such. What you are doing it as we were discussing.
Sunil, we are going to the 44 AB. 44 AB to the every person. Only to the eligible.
Agreed, it applies to a person, but it does not apply to personals all activities. It applies only to business activities. The very first, let's go step by step. The business, it only applies to business activities. It does not apply, it applies to a particular person. But first point is, I would put a point of question is that I am doing a lot of other personal activities which are not in nature of business, whether I would be covering Internal 44 AB audit. According to me, I will not be. My first question.
But in 3CD, all the details you are required to give because
now I am giving you a very important point. Let's take an example of chapter 6A. I'll come to 2 businesses also. I'll come point by point. Okay. I'll come point by point. I will come to 2 businesses also. Yes. First, I am coming to a situation where I am having a business, I am having a personal books of accounts also. Question is whether I have to cover the transactions which are reported in personal books or not. That's the very first I am coming to.
Yes, so that is the moot question.
So that's the moot question
of entire 3CD.
So because I am an issue in the report per assessee, because assessee includes all the transactions of assessee or not.
Yes.
But please mind it, when I am issuing an audit report under 44 AB, I am issuing only for business transactions. Only business is required to maintain his books of accounts under 44 AB. None individual is required to maintain his personal books of accounts. He is not required to maintain the books of accounts. He does not require to maintain his books of passbook for the PPF. Let me complete, Sunil, let me complete. So he is not required to maintain his investment schedule. He is not required any particular books of his personal affairs. He is not required to maintain his balance sheet of personal. If he is having a business, he is required to maintain the books of accounts of only that particular business. Number 1. So I was harping time and again that if there are certain transactions which are technically covered by clause 3CD, let's take an example, chapter 6A itself I am coming to. It's a very simple. I'm making a deposit of PPF, I'm making an ATC investments in my personal books. As an auditor, should I verify those ATC transactions and report in tax audit or not? When I am doing it, I am Piyush Chartered. I am practicing as Piyush Chartered and company property concern. And Sunil bhai, you are my auditor of Piyush Chartered and company proprietary entity. I have my personal books of Piyush Chartered, which is doing a huge number of investment activities, huge land banking, huge advances and loans transactions, but none falls in the category of the audit. Thus falls under 44 AB. The question arises to me is, Sunil bhai, whether you would be doing audit of this or you would be doing audit of this only business. My basis is that under 44 AB, only the business audit can be done. No other stream can be audited. It's a core business. Though the core business is related to a particular assessee, but assessee's business transactions, not other transactions. As I pointed out before also, that if it's a 50C transaction, let's take an example. It's a share deal. Do I report in 5627B? Do I report in 56? This issue will arise. If I go on reporting all the personal books, that means I'm auditing those personal books. I'm not required to personal books be audited.
That is what the requirement of the 3CD. And we are saying that the true and correct figures given in the 3CD is true and correct. We are certifying that. No? So we should not certify that then. Then we should not segregate business and correct. And in the Form 3CD, there are the number of places SSC has been mentioned. Okay, during the year SSC 57.7B, 56.7B or 56.10.
Sunil, I will share with you some precedents on this. I'll keep it this over here. I have a very different view. I will also share a judicial precedent on this to you, which will give you more comfort on this. I can at that stage I can tell you rather than entering into a discussion. My view is very clear. I am not auditing personal books. I will only audit business books. If business books does not conduct, whatever transactions are reported in books of accounts maintained by the business, only on that I will report in the form. So that's my view, obviously. And I will also try to share with Anurag, which he can circulate if there is a different views appearing on a judicial precedence in this.
Thank you, sir. Thank you.
Yes, definitely.
Thank you very much. Only concern was whether in the 3CB we are giving a certificate that the particulars given in.
I will definitely address you with the precedence on it. I will address it with the precedence.
Thank you.
Piyush bhai, same thing in when we reporting the 3CD personal item, capital expenditure, वो भी हम लोग वहाँ पे रिपोर्ट करने के लिए बोलते हैं 3CD में, लेकिन हम लोग करते नहीं है क्योंकि पर्सनल बुक्स ऑफ सेट्स को हम लोग यहाँ पे सेट नहीं करते हैं.
राइट, हम नहीं करते हैं. अदरवाइज तो सब पर्सनल एक्सपेंस आप रिपोर्ट करोगे अगर आप
पर्सनल एक्सपेंडिचर डेबिटेड टू P&L है वो.
डेबिटेड टू P&L ऑफ बिजनेस बुक्स.
एक्सपेंडिचर है तब जब आपने कंपटीशन के अंदर क्लेम किया है पर्सनल एक्सपेंडिचर, then this question may arise. Otherwise, personal expenditure is putting is a withdrawal, then it's not a question of question there.
P&L अकाउंट के अंदर या बिजनेस के अंदर कितनी बार क्या, जैसे LIC का अमाउंट आता है डायरेक्ट कैपिटल अकाउंट के अंदर डिपॉजिट होता है,
एक्सपेंडिचर क्लेम किया कि नहीं किया वही तो क्वेश्चन है.
एक्सपेंडिचर नहीं, इनकम के अंदर अपन शो करते हैं बाय कैपिटल अकाउंट के अंदर सीधा कर देते हैं, लेकिन मैनी चार्टर्ड अकाउंट उसको रिपोर्ट करते हैं 3CD के अंदर. मेरा कहने का मतलब है 3CD में रिपोर्ट करने की वहाँ पे रिक्वायरमेंट नहीं है.
Taxable income stability.
Anyways, later entering into discussion, I will send you a very good judicial precedence on this. I'll send you a note on it. So that will clarify Sunil Karia's doubts on this. My view, I'll again just sum it up. My view is I am auditing business books. I am not concerned what he is doing on his personal affairs. If he is debiting those expenses in his capital account, it's least concern to me. If it debits to my expenditure, and if it's in a personal in nature, I will report it. Yes. So I'll send on that, Sunil, to your satisfaction.
Sir, SSC has two sets of accounts. One is having 2 crore turnover and one is having 1.5 crore turnover. So audit criteria of 5% cash income or cash expenses applies each set of accounts separately, or aggregate turnover of 3.5 crore will be considered.
See, the question is, there are 2 points. Again, I will go back to it. 44AD is different, 44AB is different. If my turnover is 5 crores and I have 2 separate proprietary entities, let's take an example. That one entity has a 3 crore turnover, business entity, a particular. In which case, the turnover threshold is for a particular assessee. But when I am applying a 44AD, I am getting a benefit per business, eligible businesses. I am getting a benefit. So if I am having a commission income also, then also for an eligible business I am getting. But when I am doing an audit, let's take an example. I have 2 businesses, as you mentioned very rightly, that it is, I have 2 entities which has 2.5 crores business, one has 3.5 crore business. So all put together is exceeding 5 crores. So whether I should do an audit, I'll do an audit for 2 separate set of entities. But again, I'm not accepting for that 44AD where the eligible assessee does not include the commission income. So I will get that benefit. It's a beneficial section. A particular business only because let's take an example. I am a commission agent. Nobody stops you to do 2 businesses. I'll just answer Anurag's because this will also answer the reverse question. No assessee can be stopped with 2 business. Only because I am doing a 2 business and I am one into SME and one I am doing a commission business. I cannot be deprived of 44AD benefit to a business which is a small in nature. Only because I am doing a commission activity. Whereas there is another assessee who is only doing a single business. He is similar to me. He is a retailer. I am 2 medical shops side by side. One gets a 44AD benefit, another does not get because I am doing a commission business. So 44AD benefit is a benefit, section is a beneficial. It has to be interpreted in that particular way, which cannot be applied when I have 2 sets of a business for the purpose of a turnover threshold limit. Yes, please.
Thank you.
Sumit ji,
Hello.
Haji. Yes, Sumit ji.
Yes, sir. Till financial year 16-17, I was filing under 44 AD.
Okay.
And then in 17-18 and 18-19, the client has done audit. His turnover was around 1.5 CR.
1.5 C. Okay.
And now from 19-20 onwards, means his business is very low. Around 20 lakhs turnover is there, and now he has discontinued the business. So from 19-20, can I go back to 44 AD, or I have to compulsory do the audit?
See, 44 AD is not available to for next 5 years, subsequent 5 years.
Okay.
So with 44 AD format, it's very clear. It's not available once you have opted out of it.
But I was filing continuously under 44 AD since 16.
No, but since last 2 years you have stopped it. What you mentioned.
Yes, last 2 years I have done the audit.
Yes, so because it continues up to 5 years according to me.
Okay, so irrespective of turnover, in the next 3 years also I need under audit only.
You will be under audit because of 44 AD4 and 44 AB E clause, rate with 44 AD4, because well, SSC falling under 44 AD4, so you will be doing audit under 44 AD E actually.
Okay, sir, thank you.
in clause 27A,
Clause 27A is in required
regarding Senvet credit availment and credit.
is regard to Senvet credit availed, and you have to give the movement of Senvet credit.
Whether ITC movement is required to be given in that?
GST, ITC, according to me, yes, it should be given.
Because in the schema, in the original rules, the line is not modified yet.
Yes, it talks of moderate, I believe. Initially, it talks of moderate, then it was changed to Senvet. But basically, the intention is to give the details of income tax credit. So you should do it. And it's an information. So it has no implication. Again, there are two things I'll just add up. If you see the tax audit, there are two types of reporting. One which is only for an information, and second which may have an impact of computation. The reporting under an information basis, even if we have some iota of doubt, according to me, we should report it as an auditor, because it's only a reporting requirement. But when there is an implication on the computation of it, then obviously we have to constitute that particular requirement very strictly. As I said, if 50C is there, it's leasehold land, I will not report because it has an impact on income. Just for, but wherever there is a reporting requirement, you have to report particular transactions. Then I will report, because the Senvet credit ultimately has been now replaced with input tax credits, though the forms still continue. So in my view, it should be reported. And I believe there is an implementation guide of institute which addresses this issue, if I'm not wrong. And I'll check on that, and I'll also send that excerpt also, which says that it should be.
The other is SS 700 is equally applicable on tax audit reports, right?
Yes, please, sorry, come back.
SS 700.
Yes.
SS 700 is equally applicable on tax audit reports, right?
Yes.
But we cannot modify the auditor responsibility or management responsibility paragraph in that.
That's why observation column is there.
Because observation column is, I think it is also limited to certain words.
Connection में डालते हैं ना सर आप, connection attachment है ना आप लोग, I am sure we are putting some attachments wherever you have to give observations. Connection is permitted. That's the only way we can do in online file.
Because in Surat that responsibility statements are not in practice generally.
No, so they made see, generally what happens, this is only a casting a responsibility of management others. So in practice it may be different. As an auditor, I can give my observations thereon. And that observations, if the online does not permit me due to certain field limitations, it permits me by way of attachment, which I can do them. And I'm attaching a balance sheet. I can always, along with the balance sheet, I can attach one particular annexure of an observation. So I can at least clarify my position whenever I desire.
I think under 43B and clause section 22410, PF dates are changed for I think March and Feb. The due date of deposit of PF.
Right.
That should be properly addressed by the members this time.
Yes. Yes. Correct. That's because of COVID.
COVID.
Wherever extension, you might have to adjust all those extensions also, which has been granted up from 31st March to June. Like investment time has gone up. I think so. There's also extension in ATC and all those periods. So you can always take benefit of it. But I think so that if it's appearing in your business books and if you're actually auditing those periods, but you can take directly those benefits in the income tax return rather than covering in the audit, because those transactions are happening between April and June, which you are not auditing. So technically, you are giving an audit document for a period, so you cannot cover it in your Form 3CD anywhere. But you should take care in the computation.
हेलो
Yes, sir.
सर जी पहले सर 3 साल से पहले सर वो 3 साल पहले वो 44 एडी में था क्लाइंट, अभी 3 साल से उसका ऑडिट हो रहा है, लेकिन इस बार उसको ऑडिट की जरूरत नहीं है, तो मैं ITR 3 तो फाइल कर ही सकता हूँ ना ऑडिट भी ना?
हाँ, अगर जरूरत नहीं है तो कर सकते हो ना। देखो 5 साल का है ना, उसमें अगर ADA में गया तो 5 साल तक तो आपको करना पड़ेगा ना सर। अगर ऑडिट नहीं है
सर, लेकिन अभी आपने पहले एक डाउट हुआ तो उसमें आपने कहा कि ऑडिट ही करना पड़ेगा।
हाँ, वही तो मैं बोला, वो 5 साल तक आपको है ना वो प्रॉब्लम 44 AD से है, यू कैन रिवर्ट अप टू 5 years।
ओके सर, ओके।
Malani ji, you are having some query? राजेश जी।
पीयूष सर।
यस संजीव जी।
सर जैसे लास्ट 4 साल से एक बंदा 1.5 करोड़ का टर्नओवर कर रहा है। हेलो।
हाँ जी, हाँ जी, प्लीज।
सर लास्ट 4 साल से एक बंदा 1.5 करोड़ का टर्नओवर कर रहा है और ऑडिट करवा रहा है वो, और 31/3/20 में उसका 80 लाख का टर्नओवर है। कैन ही गो फॉर 44 AD?
अकॉर्डिंग टू मी यस। वो ऑडिट करवा के उसमें क्या कर रहा था 1.5 करोड़ में? व्हाट ही वाज डूइंग? ही वाज ऑफरिंग लेस देन 8%।
नहीं, टेक्सटाइल बिजनेस ही कर रहा था वो।
नहीं, लेकिन ऑफर क्या करता था सर? ऑफर क्या करता था?
परसेंटेज ऑफ
प्रॉफिट तो वो नॉर्मल 8% से बिलो।
आई थिंक सो ही कैन गो 44 AD के बेनिफिट लिए, मतलब उसने कि नहीं लिए?
नहीं लिया है ना।
नहीं तो ले सकता है।
नहीं तो 1.5 करोड़ के ऑडिट के ऊपर 44 AD में अगर वो 8% ऑफर करे तो ही एग्जेम्पशन अवेलेबल था ना पहले।
नहीं, जैसे 31/3/18 की बात पकड़ लीजिए, 1.5 करोड़ का टर्नओवर था, मैंने ऑडिट किया 44 AB1 में। ठीक है, मैं 44 AD में गया ही नहीं आज तक कभी। जब 44 AD में
आपकी इसलिए प्रॉफिट कम थी तो आपने ऑडिट करवा दी।
हाँ, ऑडिट करवा दी। 44 AD4 कब वायलेट होगा? जब मैं एक बार 44 AD में गया,
वापस ऑप्ट आउट करा, आपने ऑप्ट इन नहीं किया तो
ऑप्ट इन नहीं किया तो फिर मैं जा सकता हूँ।
यस।
ठीक है सर, दूसरा सवाल है 31/3/2019 में बंदे का 1.5 करोड़ का टर्नओवर है, फर्स्ट टाइम रिटर्न फाइल कर रहा है, तो ऑडिट कराना कंपलसरी है क्या? 2,40,000 का प्रॉफिट है उसका।
अभी 1920 में तो आपकी लिमिट आ गई ना सर, 5 करोड़ की, क्या चिंता है?
नहीं 19 की 31/3/19।
हाँ, 31/3 में टर्नओवर आपका है 1.5 करोड़।
1.5 करोड़ और मेरा प्रॉफिट है 2,40,00,000 2,40,000 इंडिविजुअल
बिलो ग्रॉस टोटल इनकम।
44 दूसरा इनकम नहीं है
और तो इनकम नहीं है, ये बिजनेस इनकम की बात कर रहे हैं। So between 1 crore and 2 crore, you can avail to 44 AD and then go. Otherwise, you may have to go for another. कोई लिमिट to 44 AD की आपकी 1 करोड़ को ही लग रही है ये भी मतलब।
हाँ, तो ऑडिट कराना पड़ेगा क्या उस केस में? यस, कराना पड़ेगा। ठीक है सर, थैंक यू।
हेलो।
हाँ जी
सर 3 साल से 44 AD में था, अभी उसका टर्नओवर 2 करोड़ के ऊपर, यानी कि कंपलसरी 44 AB के ऑडिट में आ गया। अभी ये कोविड-19 के वजह से उसका टर्नओवर लेस देन 1 करोड़ हो गया, तो अभी उसको 44 AD का बेनिफिट मिलेगा या उसको ऑडिट करवाना ही पड़ेगा?
3 साल से ही वाज टेकिंग 44 AD बेनिफिट।
यस, और नेक्स्ट साल उसका कंपलसरी 2 करोड़ के ऊपर टर्नओवर हो गया, इसलिए ऑडिट में आ गया।
ओके, सो उसे ऑप्ट आउट नहीं किया, वो कंपलसरी ऑडिट में आया ना।
हाँ, कंपलसरी हो गया।
फॉर एलिजिबल ही नहीं, तो अभी वापस एलिजिबल हो गया तो वो ले सकता है, कोई प्रॉब्लम नहीं है। उसे ऑप्ट आउट कभी नहीं किया, मतलब अगर 2 करोड़ के नीचे होता और वो ऑप्ट आउट करता 44 AD से तो उसको वापस प्रॉब्लम होती थी। अभी तो वो वापस जब ऑप्ट आउट ही नहीं किया, वो तो कंपलसरी ऑडिट में आ गया था 44AB में, सो ही कैन ऑप्ट इन अंडर, नो प्रॉब्लम।
और अभी बिल्डर के केस में जीएसटी पेमेंट कर रहा है और पार्टी से जो कस्टमर है वहां से वो रीइंबर्समेंट नहीं करवा रहा है, खुद के पॉकेट से डाल रहा है जीएसटी, तो पीएनएल में वो क्लेम कर सकता है क्या?
मेरे ख्याल से क्लेम कर सकता है ऑन पेमेंट बेसिस।
ओके
वो जब भी क्लेम करेगा, जैसे मैंने आपको बताया कि बिल्डर के केस में 43B में इफ यू आर मेकिंग द पेमेंट फ्रॉम योर पॉकेट, इट्स योर एक्सपेंडिचर, इट शुड बी अलाउड। बट अगर वो भी डिपेंड करता है, अगर वो परसेंटेज कंप्लीशन है, प्रोजेक्ट कंप्लीशन है, उसके ऊपर डिपेंड करेगा। अब प्रोजेक्ट कंप्लीशन है तो आप प्रॉफिट ही नहीं कर रहे तो सब आगे पोस्टपोन हो जाएगा। और परसेंटेज कंप्लीशन में तो तुम प्रोपोर्शनल रेवेन्यू के बेस पे यू कुड क्लेम इट।
विकास जी।
हेलो।
हाँ जी सर।
पीयूष भाई, मुझे एक क्वेश्चन है। मेरा क्लाइंट है, वो 3-4 साल से रेगुलर ऑडिट करवा रहा है, उसका टर्नओवर भी अच्छा है। अभी करंटली उसने बिजनेस शट डाउन करके सैलरी में चला गया।
ओके।
तो उसका अभी ऑडिट ITR 3 की जगह पे 1 आ गया है।
बराबर है, ठीक है ना।
तो जो 5 साल का था ऑप्ट आउट का, तो उसमें क्या करना पड़ेगा?
ऑप्ट आउट का आपने तो बिजनेस ही क्लोज कर दिया ना सर, ये ऑप्ट आउट का होता है। यू आर नॉट ऑप्ट आउट, बिजनेस ही बंद हो गया। अब जब चालू करेंगे वो नया बिजनेस करना जाएगा।
अच्छा, तो उसकी वजह से कोई नोटिस या ऐसा कोई फेज नहीं होगा ना?
नहीं सर, काय के लिए होगा? बट व्हाट्स द रीजन? यू क्लोज द बिजनेस, बेटर है।
हाँ,
अभी जब भी आप बिजनेस करोगे तो वो न्यू बिजनेस गिना जाएगा।
But he must have given a notice under section 176 of disclosure of business.
That's okay for the that's for closure of business. Closure of business, I think so. 176. देखो ऑडिट में उसकी कोई भी प्रॉब्लम्स नहीं है अदरवाइज।
नहीं, वो तो ठीक है। But if he gives intimation to department about this, then the department will not take any action even if it decides.
सर 176 को कभी-कभी यूज ही नहीं किया, किन्होंने भी डिस्क्लोजर ऑफ फर्म देते ही नहीं आज की तारीख में, बट डिपार्टमेंट इज हार्डली एक्चुअली टेकिंग इट।
सब भूल गए
वो सर डिस्क्लोजर उसका इसलिए इंटरेस्ट है कि कल उस फर्म की कोई लायबिलिटी आए तो उनको किसको पकड़ना है। See, intention or objective of that particular section was that. So when the liability comes, they goes into it. But if there's no liability, business has closed on, better to go. So even if you not do it, it's not been implemented practically.
Okay sir, thank you.
Yes.
टर्नओवर ही नहीं होगा तो पेनल्टी किस पे लगाएगा?
Yes sir. हाँ अनुराग जी, और कोई हो तो we can otherwise.
जावेद जी, आप कुछ पूछ रहे थे? Clause 34C of 3CD, amount of interest under section 201(1)(a) and 206(c)(7) is payable. Which amount to be mentioned in column 2?
No, please come back again.
Clause 34C of 3CD, amount
Clause
of
34C is for in regard to?
That is the late payment of TDS, I think.
Okay.
There is a column interest payable. 3CD, amount of interest under section 201(1)(a) and 206(c)(7) is payable. Which amount is to be mentioned in column 2?
When there is a TDS delay, there is an interest payable. So both, wherever the interest is payable, that interest has to be mentioned in the 201 or 06, whatever it is payable.
I think there is two columns. One is payable and other is paid date. Okay. Both are covered.
No, I'm not covered that, so I don't. But the payable is whatever is the figure you have to calculate and you have to give those payable figures under whichever section it is on TDS delays. Because 206C तो उसके लिए है ना सर, कलेक्शन ऑफ चार्ज का इंटरेस्ट आता है ना उसमें, तो TCS के ऊपर इंटरेस्ट है,
TCS के ऊपर है,
TCS के ऊपर है, तो वो तो TDS में है ही नहीं। अगर TCS का भी आप रिपोर्टिंग करो तो उसका फिगर भी देना है, इसका भी फिगर देना है, उसमें से कितना पेड हो गया वो फिगर आपको देना।
सर पहले पेएबल अमाउंट है, सेकंड के अंदर आपने जितना पेएबल हो रहा है उसका अमाउंट कितना पे किया, कौन कौन सी डेट में पेमेंट किया, उसकी रिपोर्ट देनी है। ओनली रिपोर्टिंग पार्ट है सर ये।
नहीं, वो अगर पेड में कुछ नहीं होगा तो वो नोटिस आपको दे देगा कि रिपोर्ट कर लो बस।
सर सेक्शन 36(1) में एक क्वेश्चन है, पूछो क्या? हेलो,
पूछिए सर।
सर
को बिना हाथ तो क्या हुआ? भेजे बार।
हेलो।
हाँ बोलिए बोलिए संगीत जी।
सर एनबीएफसी कंपनी है, एनबीएफसी कंपनी में स्टैंडर्ड एसेट पे प्रोविजनिंग की हुई है, तो क्या 3617 का बेनिफिट ले सकते हैं उस प्रोविजन पे?
संगीत जी ऑफर जो मैं नहीं बता पाऊंगा आपको, ये मेरे को ईमेल भेजिए, देन आई विल बी एबल टू टेल यू।
अच्छा।
Because there is a very specific provisions for financial institution and bank. Standard asset का provision आपको allow नहीं होता। मैं आपको ऑफर खाली इतना बोल सकता हूँ कि standard asset का जो provision होता है, even जो banks करती है standard asset का provision, that is not allowable. जिन्होंने भी claim किया था ट्राइब्यूनल तक का एक judgment आ चुका है कि it is not allowable. But अगर कोई specific मेरे को कोई provision हो के मैं जहाँ पे मैं claim कर सकता हूँ तो I can revert to you, but prima facie I can tell you it's not allowable.
Okay.
Standard asset का नहीं है. Only for doubtful assets.
Okay, okay sir.
7A, 7B ये सब सिर्फ doubtful assets के लिए अलग-अलग calculation formulas हैं।
अच्छा।
But sir provision तो bad and doubtful debts के लिए किया जाता है।
नहीं standard assets के लिए compulsory है ना सर? 1%, 2% जो भी है, I don't remember percentage।
0.25 to 0.40% है।
हाँ मतलब जो भी percentage हो कुछ किया जाता है तो उसको allow नहीं होगा standard assets के लिए, क्योंकि वो जो provisions है 7A, 7B कुछ एनबीएफसीज के लिए, कुछ बैंक्स के लिए,
बैंक्स
वेरी स्पेसिफिक प्रोविजन फॉर डाउटफुल डेट्स के लिए।
ओके सर, थैंक यू।
हेलो सर।
हाँ जी कमलेश जी।
सर जी गुड इवनिंग सर।
गुड इवनिंग
सर। एक क्वेश्चन ऐसा है सर के बिल्डर के केस में परसेंटेज ऑफ कंप्लीशन मेथड है अपनी।
परसेंटेज ऑफ कंप्लीशन, हाँ जी।
अभी नया AS 115 आया है। AS 115 इसके हिसाब से क्योंकि हाँ सर, तो उसके हिसाब से सर ये जीएसटी कंप्लायंस के लिए जरूरी है, क्योंकि जब भी जीएसटी का ऑडिट करते हैं तो टैक्स ऑडिट इज नॉट सपोर्टिंग बेसिकली।
नहीं मैं समझा नहीं कमलेश जी आप क्या बता रहे हैं।
सर परसेंटेज ऑफ कंप्लीशन मेथड में जब भी जाते हैं तो हम जो प्रॉफिट होता है, जो भी एक्सपेंडिचर होता है उसमें प्रॉफिट ऐड करके हम वर्क इन प्रोग्रेस दिखा देते हैं कि इतना वर्क इन प्रोग्रेस और इट इज डीम्ड सेल्स, इट इज नॉट एक्चुअल सेल्स।
इट्स नॉट एक्चुअल सेल्स और जितना प्रॉफिट होता है उतना आप बता देते हो, बराबर?
यस इट इज
बाकी डब्ल्यूआईपी में कैरी करते हो।
हाँ सर, तो अभी एक डिलोइट का मेरे पास एक ड्राफ्टिंग आया है जिसमें वो हाँ उसमें ये बोल रहे हैं कि 115 इन द केस ऑफ बिल्डर यू हैव टू फॉलो AS 115, मतलब जब भी सेल होता है तभी आपको ये कंसीडर करना, अदरवाइज मतलब ये ICDS और AS 115 और परसेंटेज ऑफ कंप्लीशन मेथड तीनों का कॉम्बिनेशन है। तो जब भी कंपटीशन बनाओ आप तो ICDS अप्लाई करना है, अदरवाइज तो सर वो कैसे, मतलब ऑडिट रिपोर्ट में हम सीधा AS 115 अप्लाई करें और कंपटीशन में मुझे ICDS अप्लाई करना है?
ठीक है, अभी मैं आपको आता हूँ बिल्डर के केस में। अभी इधर वापस मेरा एक बहुत एग्रेसिव व्यू है जो मैं जनरली वी टेक अ वेरी एग्रेसिव व्यू एक आता है। आफ्टर ICDs आने के बाद एक व्यू चलता है कि बिल्डर को परसेंटेज कंप्लीशन फॉलो करना है।
करेक्ट सर,
बराबर है, ये व्यू है जनरली। अभी मैं इसमें डिफर करता हूँ, देयर आर वेरियस जजमेंट्स, क्योंकि बिल्डर को अप्लाई होता है रेवेन्यू रिकॉग्निशन मेरा AS9 जो ओल्ड था, और इंडियस का भी जो रेवेन्यू रिकॉग्निशन है वो मेरे को अप्लाई होता है। So as per that, I am permitted to follow today also project completion or percentage completion. So if I am following that particular method regularly and which is accepted by previous judgments, ICDs cannot override on that 145. ये मेरा हम लोग का व्यू है।
Okay.
जो काफी जन नहीं मान रहे, असेसिंग ऑफिसर भी आज की तारीख में नहीं
मानते सर, डिपार्टमेंट नहीं मानते,
और ICDs आने के बाद उसका कोई जुडिशियल प्रेसिडेंस भी नहीं है आज की तारीख। लेकिन जब ICDs आया तो एक जनरल हमारा जो व्यू है, जो लीगल व्यू चलता है, वो लीगल व्यू ये है कि ICDs कैन नॉट रिवर्स द ओल्ड सेटल्ड लॉ, प्रिंसिपल्स ऑफ द लॉ, which permits you the accounting principles to follow project completion or percentage completion. So पहली बात तो परसेंटेज कंप्लीशन फॉलो करना वो कंपलसरी नहीं है, जो एक जनरल व्यू चल रहा है। ये मेरा व्यू है, मेरा पर्सनल व्यू, और काफी लोगों का ये व्यू है, और कॉन्ट्ररी व्यूज भी है इस चीज में, दो व्यू चलते हैं। दूसरी चीज जो आप मेरे को बोल रहे हो, ये ऑफ कोर्स मेरे को समझ में नहीं है कि जीएसटी के साथ ऑफ कोर्स आपके अकाउंट्स कभी रिकंसाइल तो होंगे नहीं, क्योंकि जीएसटी में आप सेल्स उस फिगर को दे रहे हो जितने भी आपने एडवांसेस किए या जितने आपने डिमांड नोटिस रिसीव किए, मेरे ख्याल से उस बेस पे आप
एडवांसेस के हिसाब से जीएसटी का रिटर्न फिल किया
मेरे ख्याल से वही होता है, जहां तक मेरी लिमिटेड नॉलेज है जीएसटी के बारे में। तो फिर वो तो कभी रिकंसाइल होगा ही नहीं, तो उस रिकंसिलिएशन में आपको बुक्स ऑफ अकाउंट्स के साथ आपको रिपोर्ट देना है 9C में, जो भी 9C या जो भी फॉर्म है उसमें आप देते हो बस। कैसे इम्पैक्ट करता है मुझे आपका प्योरली क्वेश्चन नहीं समझ में आया
सर। लेकिन ये AS 115 फॉलो करना कंपलसरी है या फिर परसेंटेज ऑफ कंप्लीशन मेथड पे ही कंटिन्यू रखे तो चले सर?
नहीं, मैं वापस से आई एम नॉट श्योर टुडे ऑफ ASI आप कौन से 115 की बात कर रहे हो। ये ASI इंटरप्रिटेशन आया हुआ है कोई चीज का कि इफ यू आर फॉलोइंग परसेंटेज कंप्लीशन देन यू हैव टू डू इन अ पर्टिकुलर मेथड। So there is a confusion. Question is, it does not accounting standard अगर है तो मुझे फॉलो करना है। This is not ASI. चाहे ASI होगा, इंटरप्रिटेशन होगा, परसेंटेज कंप्लीशन फॉलो करते हो तो आपको क्या करना है? So
but it is compulsory नहीं है सर। AS 115 till date it is not compulsory I think.
हाँ तो बस ठीक है।
ये इंड एएस की बात कर रहे हैं, डेलॉइट इंड एएस पे बात करते हैं तो उन्होंने इंड एएस के बारे में लिखा हुआ है।
हाँ इंड एएस के बारे में सर।
Then I am Kamlesh bhai, I am not aware. I can.
जब आपके अकाउंट्स इंड एएस फॉलो नहीं करते हैं तो आप उस इंड एएस को लगाएंगे कैसे?
ओके सर, ओके, थैंक यू सर।
हम लोग रेगुलर एएस में काम कर रहे हैं, उसमें इंड एएस का कोई काम नहीं है।
ठीक है।
हेलो,
यस राकेश जी।
हाँ सर, ये एक 4480 में रिटर्न भर रहा हूँ, 1 करोड़ से कम का टर्नओवर है रेगुलर 4-5 साल से।
ओके।
अभी उसमें 20 लाख की कमीशन एक्स्ट्रा, मतलब कमीशन इनकम है जो फिर टर्नओवर को 1 करोड़ से ऊपर ले जाएगा। तो ये बिजनेस इनकम तो मैं 8% या 6% में भर दूं, कमीशन इनकम के लिए फिर क्या रेगुलर
P&L फाइल करिए सर।
बस ऑडिट नहीं ना?
नहीं।
ओके सर।
4480 में आप चले गए तो नहीं।
ठीक है सर।
अगर नहीं चले गए तो वो लिमिट क्रॉस 1 करोड़ के ऊपर क्रॉस होगी, फिर आपको उसके हिसाब से देना है। फिर तो अभी तो 5 करोड़ है, मतलब 2 करोड़ तो भी लिमिट है।
ठीक है, ओके, थैंक यू।
कोई भी बिजनेस हो जिसमें लॉस हो रहा है और टर्नओवर 2 करोड़ के नीचे है तो उसमें तो ऑडिट कंपलसरी वैसे भी नहीं होगी ना सर। तो नॉर्मल रिटर्न भर के हम कर सकते हैं ना।
हाँ 2 करोड़ के नीचे जो 2 करोड़ की लिमिट है, लेकिन 2 करोड़ तो 4480 के लिए, सॉरी सर, 2 करोड़ की लिमिट तो 4480 के लिए है सर। 2 करोड़ की ऑडिट लिमिट है।
2 करोड़ के नीचे है और मेरा बिजनेस में लॉस आ रहा है, मैंने बुक्स ऑफ अकाउंट मेंटेन किए, उसमें से लॉस आ रहा है, तो मुझे ऑडिट करने की जरूरत नहीं है ना, नॉर्मल रिटर्न ही फाइल करना है ना।
यस यस यस।
I think all the queries have been solved. We are planning a next session on Tuesday.
अनुराग जी सॉल्व तो पता नहीं, लेकिन मैंने मेरा पर्सपेक्टिव जरूर दिया है। लोगों के बीच में काफी अभी भी कंफ्यूजन है श्योर 4480 को लेके। मैंने मेरा पर्सपेक्टिव जरूर दे दिया, मेरा व्यू जरूर दे दिया मैंने।
पीयूष सर,
हाँ जी
सर सॉरी, वो क्वेश्चन में एक पॉइंट अधूरा रह गया। जैसे 115 जेबी में जो प्रोविजन है फॉर अनसर्टेन लायबिलिटीज की, तो क्या 115 जेबी में उसको एड बैक करना पड़ेगा जो मैंने पीएनएल में डाला है उसको?
अगर वो क्लॉज में फॉलो होते हैं जो अनअसेटेड लायबिलिटीज के लिए आपने प्रोविजन किया है, जिसको हम सीक्रेट रिजर्व बोलते हैं या सीक्रेट प्रोविजन बोलते हैं, उसको एड बैक करना चाहिए 115 जेबी के लिए। 115 जेबी की बात कर रहा हूं मैं।
हाँ 115 जेबी में ऐड करना चाहिए उसको।
यस, इफ इट इज प्रोविजन फॉर अनअसेटेड लायबिलिटीज।
मैंने स्टैंडर्ड एसेट का प्रोविजन किया है एनबीएफसी के केस में।
सर वो अनअसेटेड लायबिलिटी नहीं है, इट इज अंडर अ स्टैट्यूट।
ओके,
इट्स अ डिफरेंट। उसको स्टैंडर्ड एसेट को आप मत पकड़िए सर। और स्टैंडर्ड एसेट जो आप बैंक में करते हैं, एनबीएफसी में करते हो, वो दिस इज अंडर स्टैट्यूट, इट्स अ कंपलसरी। यू कांट से दिस प्रोविजन फॉर अनअसेटेड लायबिलिटी।
ओके ओके, थैंक यू सर।
यस अनुराग जी।
We are planning a next session on Tuesday by CCM Pramod Jain ji on finalization of account after this COVID. And I will request CS Sanjeev Jain ji to cast vote of thanks.
अनुराग जी, I will do and send, जैसा आपने भेजा मैं प्रेजेंटेशन भेज भी दूंगा।
Yes, sir.
और वो जो स्पेसिफिक एक किसी की मोदी जी की मेरे ख्याल से क्वेरी थी, तो मैं आपको ट्राई करूंगा ईमेल करने।
सुनील जी की।
ये जो बिजनेस का शेयर विद हिम। किनकी थी आई डोंट रिमेंबर।
सुनील जी की।
सुनील जी की। आई ट्राई टू सेंड यू दैट आल्सो।
Okay.
So आप मेरे को आपका ईमेल।
I will share with you.
Yes, so whatever I can share my views on that.
Sanjeev ji.
Dear members, CA Piyush Ji Chhajed has very lucidly expressed his views on audit under Section 44AB and AD of the Income Tax Act. It has surely enriched our knowledge and will be definitely useful to us in the forthcoming audit season. Sir, we are really grateful to you for sparing your valuable time and sharing your thoughts on subject. I am sure members of Textile Market CP Study Circle have been benefited from the views on the subject shared by you. On behalf of the Textile Market CP Study Circle, I extend my sincere thanks to you for addressing this gathering and sparing valuable time with members of Study Circle. And lastly, I am thankful to the members for attending the CP meeting in large number. Thanking you.
Thank you, sir.
Thank you. Thank you.
Thank you.